to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
Concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, EConcrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
EConcrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, EConcrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing EConcrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
EConcrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in the case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. EConcrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, EConcrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
2 p.m. on Wall Street, we have a move up in long-term interest rates and weakness in some of those high-flying, high-valuation tech stocks. From Bloomberg World Headquarters in New York, I'm Doug Krisner. The good news, if you're long this market, is that we are off session lows. Earlier, the S&P 500 index had been down by more than 1%. Right now, we're off about 0.9%. Goldman Sachs earlier saying that the firm is now expecting the Fed will likely raise interest rates 4 times this year, and it will begin with the balance sheet runoff process in July, if not earlier. Now, at this point in time, the market is only pricing in about 3 rate hikes for 2022. We've got a 10-year Treasury up more than a basis point in yield. We're at 177. We had traded as high in yield terms as 180 earlier. Obviously, inflation is the problem. And today, the former president of the New York Fed Bank, Bill Dudley, was telling us the Fed really needs to get more hawkish right now.
I think they should go faster than what's priced into the market. I mean, obviously, it's going to depend a bit on how the economy evolves. But my best guess is, that they need to do at least 4 or 5 rate hikes this year. And it wouldn't strike me at all if we get into an every meeting kind of cycle at some point.
So right now, we've got the Dow lower by 0.8%, and in the NASDAQ market, the composite index down about 1.2%. Lululemon Athletica shares being hard hit today, off 4.5% after the company warned financial results will come in at the low end of its previous guidance. Also, we have shares in the video game maker Take-Two Interactive Software lower by more than 14%. The company is buying the mobile game maker Zynga. Price tag on this deal is about $11 billion, and Zynga shares right now zinging to the upside. Pardon me for that. A gain of 42% right now. Well, we've got a stronger dollar with the Bloomberg Dollar Spot Index rising 0.2%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
And a very good afternoon, everyone. Live from the Bloomberg Interactive Brokers studio. We are streaming on YouTube. It is Monday, January 10th, 2022. Carol Massar, Tim Stenovic. We're down again, but as Doug just mentioned, we're definitely off our lows. In fact, we're building towards our best levels of the day, especially on the NASDAQ.
Still, those stocks on their pace for their longest losing streak since September. At one point today, Carol, the NASDAQ was at levels last seen back in October.
Interesting, though, to see some buyers come back in, right? To kind of
Is this the bottom of this?
I am not smart enough to call a bottom, but a lot of people are out there doing so. We're going to talk about that. And don't forget, we've got earnings starting off in a big way this week. It's going to be another big week here when it comes to news and also how we trade. Also, amid COVID, watching that, safe to say we have a more informed understanding of mental wellness. Weighing in on that, we're going to have Jeff Jonas. He's the Chief Innovation Officer over at Sage Therapeutics, coming from that J.P. Morgan Healthcare Conference, which is virtual this year.
Yeah, that news announced just a few weeks ago seemed like a turning point, I think, for a lot of us in thinking about Omicron. Hey, speaking of the virus, Carol, out sick. It's the latest cloud over our economic outlook. We're going to explain.
Yeah, we are. And speaking of clouds, a little cloudy for Intel going forward. We'll get to that. It's an interesting story in the magazine. First up, though, let's get to the Market Drivers Report. Let's set the Business Week agenda on this Monday. Kriti Gupta, Bloomberg Markets correspondent at Bloomberg News, on the phone in our New York City bureau, and on the phone in New Jersey, Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. We're going to talk earnings with her in just a moment. Kriti, though, set the stage. We're off our lows here on those equity averages. What's going on?
Yeah, we absolutely are. And what's interesting to me here is everyone is kind of waiting. Is this the end of essentially the sell-off that we've been seeing for seems like for days now? I mean, just let's put this into some perspective. The S&P 500 is down about 5% peak to trough in just the first part of 2022. Like I said, peak to trough. Compare that to the last two, what I'm going to call mini corrections. And we're looking at a 5.2 and 5.9% drop in December and September, respectively. So if we kind of see the historical pattern follow in terms of the percentage moves, this might be kind of gearing towards the end of selling. But remember, who is really behind this? Lou Wang did put out a great story that it's hedge funds that are ultimately making these pretty huge moves. But remember, tech leads us to record highs. They also lead us to the corrections, and that's kind of what's happening right now.
Hey, Gina Martin-Adams, come on in here. Look, you've got a new note out that talks about an earnings doozy ahead as fourth quarter guidance drops, while at the same time we're seeing consensus rising. I want to get to that in just a second, but help us make sense of what's going on today and what's happening in the first 6 trading days of 2022. What do you make of it?
Yeah, I mean, some of it is just an unwind of a little bit of a surge that we had in the Santa Claus rally that proved to be a bit of a false dawn. We had been in a range trade for much of the final few months of the year. We suddenly sparked this nice little Santa Claus rally, and now we've given it back. Part of it is also just a function of what's happening with, Fed policy. This was always going to be the year in which the training wheels came off. The training wheels are coming off perhaps a little faster than many market participants had anticipated coming into this year, and that's created a bit of a gyration. But also, it's just a different character of market going into 2022 relative to 2021. There's, a more dependence upon earnings growth. Earnings growth is slowing, and that creates a bit of a different landscape. Today is the first day of the sell-off, though, in which investors have really sold everything. Prior to today, it was really more about rotation, where losses in tech were offset by gains for some of the value-centric, really cyclically positioned sectors, which was certainly gave us a little bit of hope. Today, it was more about just sell everything and think about it later.
Well, and that's a really good point. I mean, Crete, come on back. In terms of sector rotation or sector movements here, Gina points out, I think that's significant. The first day that we're seeing a selling of everything, and yet we are seeing there's some bottom buying as well here.
Yeah, there is a little bit. But remember, going into the end of 2021, we were seeing a little bit of that defensive positioning anyway, not just in terms of perhaps a bid into tech, but you were seeing it in utilities, real estate, consumer staples. You didn't really see the value trade, which I think was supposed to be kind of the poster child of 2021. You didn't see that show up. That being said, going into 2022, I think Gina's 100% right, is that, yes, you were seeing kind of that sector rotation. Now it kind of seems like, this might be a dramatic word for what's happening, but a capitulation, basically. I'm going to steal what Tom Keene said this morning, but if you actually look at the moves, we were down, say, 2% on the NASDAQ. Even if you look peak to trough, like I said earlier, it's only 5% of a drop. So it's actually not as bad as perhaps it seems. We're just out of practice and seeing what a correction looks like.
I'm going to steal something from Tom Keene a little bit later on, too, for our market chat, because he was saying something that's really stayed with me. Hey, Gina, just got about 45 seconds or so left here. In terms of the earnings growth, we know it's going to slow down. What kind of recalibration in the market, though, will it support? Will it continue to support some kind of gains in the equity trade?
Yeah. It should continue to support gains. One of the more stunning facts of this earnings cycle, first, it is worth recognizing that this has been the fastest, most robust recovery in earnings that we've seen in post-World War II history. Absolute stunning earnings growth throughout the latter part of 2020 as well as 2021, took consensus completely by surprise, even took companies themselves by surprise. We've never seen companies guide so positively. That now we seem to be returning more to a normal environment, but even our earnings models say you could get nearly 20% earnings growth in 2022. That is nothing to snub your nose at. In the grand scheme of things, we're used to 6 to 10% earnings growth. 20% earnings growth in this kind of economic climate is still very supportive, generally, of a fairly constructive outlook to risk.
And that's even, Gina, in a how does a rising rate environment play into that? If we start to see the Fed being more aggressive, which Bill Dudley says, come on, folks, you're behind the curve. He fell down the rabbit hole and citing Alice in Wonderland and all this great stuff. But what does it mean in terms of earnings growth in a rising rate environment?
Yeah, it simply means that your multiples may be constrained because rates impact the multiple more than they impact earnings, right? But you have to consider why rates are rising. Rates are rising because economic growth has recovered. Rates are rising because the economy is stronger than many had anticipated and certainly doesn't need the support of incredibly low interest rates. So as long as the balance is there and rates are rising for the right reasons, it's generally a pretty constructive outlook for stocks. And stocks do tend to rise in periods where short-term interest rates are rising, as long as the yield curve isn't inverted, and that certainly is not in many folks' forecast.
Okay, apart from earnings, which we know are coming up this week, starting with the big banks, we're also going to hear from Delta Airlines on Thursday, really kicking things off for us. Crete, what else are you keeping an eye on in terms of economic data and in terms of catalysts that could move the market either way?
CPI, should I say?
Yeah, that's what I was looking for.
You read my mind, Carol. It is about CPI on Wednesday, but I'm still more interested in where we are in the market about actually how many hikes are being priced into the market. Is it 3? Is it 4? And it kind of seems like that fourth hike that Jan Hatzius over at Goldman called straw that could potentially break the camel's back, depending on kind of that bond market pricing. But once again, there isn't a consensus about whether there's going to be 3 or 4 hikes this year.
Well, exactly. I mean, lots of debate out there. And, now I'm going to just put out what I heard from Tom Keene on surveillance, and I'm going to owe him royalty fees after the end of this week. But he talked about original economics, and we are making it up as we go. And that is one thing, right, Gina? I mean, we have never, you talked about the dramatic growth and comeback we saw in earnings growth. We have never lived through, most of us, none of us, have lived through an environment like we are going through. We don't know exactly how it all plays out.
Yeah, we certainly don't. And frankly, this is a discussion we have following every economic recession. Every recovery is different. Every expansion is different. This one feels particularly profoundly different, obviously, considering the pandemic environment. The other thing that we've never been through is a point in time in which fiscal and monetary policy combined commanded 60% of GDP growth, and that was the state of affairs in 2020. We've got to get to a point where, private sector drives GDP growth again, where policy is not such an extraordinary input to really get back to some semblance of normal. And most people, certainly the prevailing thought process is that's not necessarily going to be as easy as we would like it to be.
Right.
And many people are very cautious as a result.
Right. And fiscal stimulus and monetary stimulus from central banks is not sustainable. That's not what keeps an economy going or earnings growth. Kriti Gupta, Bloomberg Markets correspondent, and Gina Martin Adams at Bloomberg Intelligence. Thank you so much. You're listening to Bloomberg Business Week, and this is Bloomberg Radio. All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. So, man, a lot in that opening section about what to think about when it comes to the markets. In the meantime, you cannot forget the pandemic, and that is always the caveat whenever we speak about anything having to do with outlook.
Okay, so let's talk a little bit about what we're seeing in terms of the data right now. A couple different stories catching my eye today, Carol. One has to do with our own state. New York seeing signs of an Omicron peak while ICUs still remain pressured. The 7-day average of people visiting New York emergency departments with COVID-like illness, that's actually dipped significantly in all 5 boroughs since the end of December. This is according to data from the New York City Department of Health and Mental Hygiene. The Bronx actually saw the biggest drop, with the 7-day average retreating 35% in the week through Friday.
Okay, and a little caveat, because New York officials did warn that the recent data is subject to revisions and are affected by a degree by the holiday effect, which can artificially depress trend lines due to delays or underreporting. So gatherings during the New Year's Eve holiday could also prolong the COVID spike. But, this is so important, right, Tim? They're looking for a deceleration in the rate of growth. They're not seeing that yet, but that's what they're looking at in terms of the data. And this has to do with, do we see peak in the near weeks? We think about the data out of South Africa and wondering,
I was just going to go there.
Do we follow that? That's a younger population, right?
It's also summer there.
It's also summer. So you do wonder how that might skew the numbers that we ultimately see in here. But hopefully, I don't know, by the end of the month, maybe beginning February.
Yeah, fingers crossed. Hey, a lot of parents also struggling when it comes to school closures. And, everyone knows that at this point, right? The disruption that causes. U.S. school closures reaching a record high, Carol, for the academic year last week as Omicron-fueled COVID cases caused staff shortages and disrupted classes. Those shutdowns, though, those are about to ease as more schools are set to reopen in person. So some good news there.
Exactly. At least 5,409 schools had canceled class or switched to virtual learning as of the end of last week, more than triple the count at the end of December. This is according to data from Burbia, which tracks closures, concentrated in the Northeast and Mid-Atlantic regions, as well as Chicago, where we know that labor dispute has led to hundreds of closures. But this is something we're keeping an eye on. Again, we'll go back to the playbook. We've got it a little bit. We know that if you close down and maybe...
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Well, the equity market's trying to stage a comeback here. The S&P 500 earlier had been down 2%. Right now, I'm seeing a loss of merely 0.6%. To be fair, long-term interest rates remain elevated, although in yield terms, we are off the high point of the day. 10-year Treasury earlier was trading with a yield of 180. Right now, we're 177. Dow Industrial Average is down about 0.7%. Similar decline for the NASDAQ Composite. In the broader market, the decline here is being led by consumer discretionary shares, and this is really a story about Nike. The stock is down about 5% right now after a downgrade today at HSBC. The firm, or the bank, I guess you could say, is seeing Chinese demand being lackluster for Nike. HSBC noting some currency moves lately have turned against the sector, and now HSBC says valuations for Nike are unsupported. We also have a little bit of weakness in many of the payment stocks today, given the spike in rates. Seeing shares in MasterCard right now weaker by a little more than 1.5%, and PayPal off by more than, let's call it 3.5%. We've got Bitcoin trading 41,600 right now. We broke below 40 grand earlier in the day, but as the equity market stages a comeback, we're seeing a bit of recovery in Bitcoin as well. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, really appreciate it. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. The 40th annual J.P. Morgan Healthcare Conference underway virtually. It's the event where really anything in the healthcare space and everyone involved in the healthcare space typically gather on an annual basis. As we mentioned, it's virtual this year. And one of the companies participating is our upcoming guest.
Jeff Jonas is Chief Innovation Officer on the Board of Directors of Sage Therapeutics. Jeff joins us on the phone from Florida. Jeff, how are you?
You're all well, and thanks for having me.
Yeah, thanks so much for joining us. First off, an update from what you're seeing right now at the J.P. Morgan Healthcare Conference. I know that you're attending it virtually as of now, as everybody is doing, but give us an update on really what the read is.
Well, it's a funny time. This has been a funny conference. It's been, as you've mentioned, a standard get-together, a conclave for biotech and pharma for decades, and this is the second year it's been virtual. That said, I've been attending virtually. There's some interesting news in the CRISPR space, some M&A, but it's still not the same as being packed like sardines in Union Square, I can tell you.
Which right now we're glad not to be packed like sardines. Hey, Jeff, one thing, though, I do think about the pandemic and how it's affected the medical community and all of us overall, the questions, the information we've learned as we've watched vaccines being created and understanding, the process, if you will. And I also think the world at large, the importance of mental wellness. We're talking about it like we've never before. How do you see the pandemic kind of impacting that world and your world specifically?
Well, I'm a psychiatrist by training, or a recovering psychiatrist, and if you look at what's happened, I think, as you pointed out, we've seen a vast increase in the diagnosis of people suffering from mental health disorders, anxiety disorders, and really across the economic and age spectrum. It's not focusing on any particular segment. It's really all of us. And, there's actually some really good data around this. And without belaboring this, if you look just, for example, the economic cost in the U.S. just for depressive disorders, in the year 2000, it was about $300 billion, which was very substantial. In 2021, the estimate of the cost of depression is almost $800 billion, more than 2.5-fold what we saw in the year 2000. And the same has been true, that kind of increase, for neurological disorders. So I think we all know this. Our lives are different. People are under stress. There is a paucity of availability of mental health practitioners. People are isolating more.
Right.
So it really is a perfect storm.
Well, but Jeff, I hear the data from 2021, and I ask myself, is that actually measuring the effect of the pandemic? Because here we are in 2022, and we're entering year 3 of the pandemic. So I'm wondering to what extent you can actually attribute that increase in depression and anxiety to the pandemic versus what we won't see for years to come.
Oh, I think that's exactly right. And remember, these are all instantaneous numbers or incidents, as it were. The sequelae or the after effects of what we're going through now, I think many of these things are still yet to be counted. So, I think that's why we're seeing, this negative impact on brain health and the increasing diagnosis of depression and anxiety disorders across the board.
Hey, what about too, Jeff? We talk so much here at Bloomberg about data collection, right? the pros and cons of data collection, right? But I do think about the data that's being collected during the pandemic about mental wellness, how that might help us in terms of figuring out more productive, more constructive strategies to really help all of us with our mental well-being.
Well, I think that's a really important point. And mental health has not been on the forefront of people's minds, over the last decade, even though it is almost a crisis in our ability to deliver beneficial care. And I think the data we're acquiring now are really pointing out to the area that we have significant unmet medical need. We don't have enough practitioners. There hasn't been a lot of innovation in mental health medication and treatment over the last 20 years. So there's been a paucity of that sort of innovation as well. So our hope is, and again, the data are still coming in, that with better data and more information, we'll be able to craft better therapies that are really more tailored to individuals versus the sort of one-size-fits-all that's really predominated, especially in psychiatry over the last 20 years.
So what does that actually look like on a practical level?
Well, the first thing we have to do is start looking at people's individual problems and the socioeconomic issues, but more importantly, to make accurate diagnoses and to provide therapies as quickly as possible. If you think about this from a medical standpoint, if you had a broken leg, you wouldn't wait around 2 months in order to get better or to see a doctor. And yet we don't treat mental health with the same urgency, and these are life-threatening conditions that we do with other medical conditions. So if you need to see a psychiatrist, you may have to wait, several weeks or if not months, or a psychotherapist. And so the kind of data that we need and what we're seeing is really demonstrating not only the economic loss, but the personal cost of delaying therapy and not having better access to mental health across the board.
All right, we've got to run. Hey, Jeff, come back anytime. We'd love to continue this conversation. Jeff Jonas, he's Chief Innovation Officer, Board of Directors member, former CEO of Sage Therapeutics, joining us on the phone from Florida. I do think the increased conversation we're having about mental wellness is really important.
Yeah, and I think his point about, what this looks like in a few years really stands because we don't know the effects.
Yeah, exactly. And personalization, right? Individualization, that makes a lot of sense to me. Medicine increasingly moving in that direction. This is Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. We're going to be talking a lot about the economy. Don't forget Fed Chairman Jay Powell up on Capitol Hill, his confirmation hearing. And then we've got this great story on the terminal.
Yeah, this one by Sean Donnan, senior economics writer here at Bloomberg News. It's all about Omicron absenteeism and the economic effect that it's having. We've all seen the personal effect that it's having on us, but hey, all those absences, that has an economic effect.
Yeah, so we're going to get into that in just a moment. First up, though, back to your top business stories. A look at that trading day. And Doug, we're off our lows here.
Yeah, we are by quite a bit. Earlier, the S&P 500 was down about 2%. Right now, the loss is only 0.6%. We know the story on long-term interest rates. They are elevated. That trend has been in place for a while. And needless to say, it's triggered some selling in stocks with high valuations, principally those tech names, right? So here's the question. When will higher rates dampen the urge to buy the dip? Well, in the bond market today, the yield on the 10-year climbed to just above 180 before retreating. Right now, we're trading 177, and that move seems to have created a little bit of a buy-the-dip mentality in the equity space. So we have the NASDAQ composite now back above that 200-day moving average. Earlier, it took out that level. NASDAQ comp only off about 0.7% right now. Goldman Sachs earlier in the day was saying it's expecting the Fed to increase interest rates 4 times this year. Right now, market's only pricing in 3 rate hikes for 2022. Consumer discretionary moving lower. That's a Nike story. HSBC downgrading the stock today. Nike shares off 5%. Lululemon Athletica getting clobbered today after warning financial results will come in at the low end of its previous guidance. And the video maker Take-Two Interactive Software rallying. The company, or I checked that, the stock is actually down. What is rallying is the takeover target, Zynga, the mobile game maker. Zynga shares right now, let's just get that quote, up 42%. Take-Two Interactive shares weaker by more than 14%. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, really appreciate it. Doug Krisner there with that Bloomberg Business News Flash. Well, as we mentioned, a lot coming this week on the U.S. economy. Fed Chief Jay Powell up on Capitol Hill for his confirmation hearing. And a lot is on the terminal and at Bloomberg.com about interest rates and inflation. New York Fed President Bill Dudley weighing in. Goldman Sachs also with some comments, both writing about, Tim, more aggressive Fed tightening cycles. They're all looking at the economy thinking the Fed has to play catch up.
Well, do they?
However, do they?
That's the question. Because we're also seeing some major disruptions as a result of Omicron. A great story on the Bloomberg terminal by Sean Donnan and other of our Bloomberg economics colleagues here. Sean Donnan is senior economics writer for Bloomberg News. He joins us on the phone from Maryland. Sean, I was having a conversation with a friend earlier this morning over text because we were talking about the disruptions happening at our kids' nursery school, and she wrote that short staffing because of COVID is the new supply chain. And I said, oh my God, you're absolutely right. You hit it. The nail on the head. What have you found about the economic effects of all of these workers calling out sick?
Well, that's a great way of thinking about it. This is, if you remember back that supply chain crisis that hit us all last year, started to hit at the tail end of 2020, that's something that we weren't really expecting in terms of an economic impact. And as we were going into this Omicron variant, we had kind of gotten into a groove in how we deal with surges. The economy and businesses have become pretty good at adapting to new conditions. And then all of a sudden, we've got this new condition in the economy, which is just we've got a lot of people out sick in America right now because we're getting all of these positive tests. And people may not be getting as sick broadly as they were beforehand, but they still have to stay at home and quarantine for 5 days, 10 days, depending on the business that you work for. That may affect their family members who may be forced to stay home because of rules as well. And at a certain point, when you start talking to businesses, they're saying, actually, this is having a material impact on our ability to do business. So I talked to Lido Pizza, which is a pizza chain down here, and the CEO, James Beal, it's a family company. They've been around since 1955. He's never seen anything like this. He's literally having to shut stores because they don't have enough people, and they don't have enough people not because they can't hire enough people, which was a lot of the impact last year, but because they got too many people calling in sick right now.
Right. And we've all been places where we see signs that they just, close because they just don't have enough workers. The other thing, though, Sean, I'm thinking about is the markets have this great ability to look through things. We've had a lot of guests coming on, like we have to look through this period of Omicron and just get to the other side of the economy, and things start to bounce back pretty quickly. Why shouldn't we just be doing that here? Like, we understand what's going on, and why won't it just be maybe a few-week thing where we'll explain away in the data points what was going on and look forward?
Oh, sure. I mean, look, it absolutely could be a question of just a few weeks. And we've seen that. A lot of people point to what happened in South Africa, what's been happening in the UK. Already some signs possibly out of New York that the Omicron cases are peaking there. But really, we've also got to think about the scale of the impact and how that kind of flows through the economy right now. There's an economist I like called Nick Bunker. He's the chief economist at Indeed, the job site we're all familiar with. And he grew up in the Boston area, and he says this is a lot like the blizzard of '78, which is this legendary blizzard that hit New England in 1978, which up to 4 feet of snow get dropped on the economy. And for a few weeks there, you have this huge disruption in the economy. There's a huge cleanup operation. There's a big bounce back. But you got to think about this as not just a regional economic event. This is like the blizzard of '78 kind of hit everywhere in the U.S. at the same time right now in terms of workers staying home. And that's a big deal. It may not be as big a deal as what we saw in March and April of 2020 when we had these lockdowns in place and the pandemic was very new. We've adapted. We're all working from home, or a lot of us are working from home. We're finding new ways to work and do our jobs. But it could be pretty short and sharp, and that could flow through as well into supply chains. What if that brings us back to a place where, for example, those parts shortages that we were seeing last year that were pretty acute, again, those get extended further into this year, and that starts affecting GDP. And that's one of the reasons we've seen economists downgrade their growth forecast for the first quarter. And, that's the quarter we're in now. We can look at what's happening now. We can expect good things on the horizon, but, it pays to pay attention to what's happening around us now as well.
Yeah.
Hey, Sean, what's the most important piece of data that you're going to be watching for in the coming weeks to help us understand what actually happens with the Omicron variant in regard to economic impact?
I think there's a couple of things. One is what really happens to some of the big industrial companies like the automakers, and how many people do they have out sick, and does that really then again flow through into the economy? And remember that story about car prices that we were all telling last year, and inflation. So what do we see in kind of heavy industry like that? The other one is one that's kind of harder to get a handle on, and that's, I wish we had a ticker on the terminal for how many Americans are out sick on any given day, because in some ways that would be the best economic barometer you could have right now.
Sicko. I wonder if our programmers are listening. Hey, one thing I do think about, though, and I highly recommend if 60 Minutes did a great piece about kind of what's going on in the U.S. labor force right now. I do wonder, too, Sean, for companies who are like, man, I don't want to ever be in a position where we might go through something like this and where my, reliance on workers just really makes me so vulnerable. I want to automate as much as I can. I wonder how much automation is going on that's going to stay with us forever in certain industries that will impact the labor force for years to come.
I think there's no doubt that one of the long-term, I'm going to call it a scar here, but it's a change, and some will see it as a positive change in this economy, is going to be more automation. I'm going to bring us back to Lido Pizza here in the D.C. area. They've got 110 stores. It's a pretty thriving pizza chain here locally. They have 1,300 fewer people that they employ today than they did before the pandemic. And that's not about being out sick. That's just fewer staff that they need. And what they've done, according to the CEO, James Beal, is part of that was driven by shortages in the labor market, the hard time that they were having finding workers.
Right.
But they've adapted, and one of the ways they've adapted is they've automated their ordering process. They've thinned down their menu. You just don't need to deal with as many people as you used to get a pizza at Go Pizza, and that's a scar in this economy.
Gotta run. Sean, it's a great story. Sean Donnan, he's senior economics writer at Bloomberg News, joining us on the phone from Maryland. You're listening to Bloomberg Business Week, and this is Bloomberg. All right, you're listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic here on Bloomberg Radio. And interesting story and a lot we're going to talk about from Sean Donnan. But I just think about, what changes, what stays with us in the years to come. In the meantime, that's the thing that worries us maybe about the future. What gives me some confidence is that companies are still doing deals. And we had a crazy M&A deal flow last year, and it's continuing here in the new year.
It's continuing. Call it Merger Monday today. Take-Two Interactive to buy Zynga in an $11 billion mobile gaming deal. It's a costly purchase that's, though, intended to help the publisher of Grand Theft Auto break into the fast-growing market for smartphone games. You might remember Zynga, Carol, as the company behind Farmville, the super hot at one time game that was played on Facebook. That shifted. As that declined in popularity, they shifted more to mobile gaming, and are being bought, I should say, at quite the premium.
Well, and it's interesting. You're right. The offer for Zynga is $350 in cash, $636 in Take-Two equity. So it's a cash and stock deal, if you will. Transaction amounts to an offer of $9.86 per share. That's a 64% premium to Zynga's closing share price on Friday. Interesting, too, though, in terms of consolidation. And you do think about what they get from each other, the synergies as a result as well.
Yeah, the deal will see the creator of the best-selling PC and console games like BioShock and Red Dead Redemption. They're going to join with the maker of
Farmville. You say that like you know. Do you play these games?
No, I don't. And actually, it's funny. I never got into Farmville. We were talking about this on Quick Take Stock earlier today, and it turns out Katie Greifeld was tending the fields on her laptop years ago on Facebook. She was talking about that her freshman year of high school. She was doing that a lot. The company said the deal's enterprise value is $12.7 billion. That includes debt. Shares of Take-Two falling as a result of this deal, but you're seeing shares of Zynga popping.
Not surprising. Usually the acquirer, we often see some pressure. Stock's down about 14.3%. Zynga up 43% as the target. What's interesting is the deal is valued at $9.86 per share. Right now, the stock is trading at $8.59 a share, so below that offer price. So I do wonder, what's the market telling you?
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Equity market is on the back foot today, but we are off session lows. The S&P earlier was down 2%. Right now, that loss is just 0.6%. Some stock stories driving the price action. Let's begin with Nike. Those shares weaker by more than 4.5%. HSBC downgraded Nike today, seeing Chinese demand remaining lackluster. HSBC also pointing out that some of the moves that we have seen in the currency market will work against the sector, and I'm talking about athletic footwear. HSBC saying that valuations are now unsupportive. Right now, if you look at Nike, as I mentioned, down 4.5%, and that's helping to lead the consumer discretionary group lower, and that is really providing the leadership for the decline that we are seeing now in the S&P 500. Lululemon Athletica shares down by 3% right now. This is after the company warned financial results will come in at the low end of previous guidance. A little bit of M&A activity to talk about. The video game maker Take-Two Interactive Software is buying the mobile game maker Zynga. This is an $11 billion deal. Shares in Take-Two right now off nearly 15%. Zynga shares rallying by more than 43%. We've got the Dow weaker by 0.7%. Similar decline for the NASDAQ comp, and a 10-year Treasury yielding 1.77%. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, thank you so much, Doug Krisner there. Well, this week, Bloomberg Business Week's magazine, it's all about the year ahead issue, those things to keep on your radar in 2022. And Tim, that includes, of course, the semiconductor space. Big story last year. It's going to continue to be so this year. Innovation disruptors and just plain old competition playing its way out.
Yeah, the big question is who reigns supreme, and how about the longtime, kings of chip making or king of chip making? Does it remain king?
We have our own king of chip making.
We do. It's Ian King. He's U.S. semiconductor and networking reporter at Bloomberg News. He joins us live from the San Francisco studio. Ian, it's always great to have you on the program. Let's talk a little bit about Intel, because the company is on the brink of losing its status as the world's largest chip maker. I thought that Pat Gelsinger came back to Intel to prevent this from happening.
Yeah, no, that's what he's been talking about. He's very, very focused on basically restoring Intel to its dominance. You remember when he left in 2009, Intel was at the peak of its powers. It was the largest chip maker by market value, the largest chip maker by revenue, the leader in terms of technology, the best plants, the best profit margins. It really was a leader, and now it's not. It's arguably going to lose the last of those titles, which is the one by revenue in 2021, and really everything that he's said since he took over last year is, look, I'm going to get Intel back. I'm going to put Intel back where it belongs.
So, hey, Ian, it's still going to be a dominant player, Intel that is, but what's the significance of, Intel and the history of what it has done in terms of chip making and just really Silicon Valley? How is that just kind of remarkable in terms of this shift?
Yeah, I mean, Intel basically taught the industry that, these are the economics that matter. Moore's law that everybody quotes, Gordon Moore, the founder of Intel, it's about economics. It's about scale. It's about speed. Intel has always had the most capital to deploy. It's always moved faster. It's always made it difficult for the opposition to keep up. Now it's facing, and we talked about Samsung in the story, but also TSMC in Taiwan, companies that have as much access to capital, that are deploying as much capital, that are running just as fast as Intel, and they're enabling lots of other companies who they manufacture for to compete and to take market share away from Intel. Clearly, that's not good for Intel. As you say, it's still a huge company. It's $70 billion of revenue is not to be sniffed at. But that kind of lead, that ability to say, hey, here we are, you need to come chase me, and this is the pain that is involved in chasing me, that's gone away.
What do analysts say about Intel's ability, or Pat Gelsinger's ability to pull this off?
Yeah, I mean, it's initially when he came, back to Intel last February, said all the right things, said, look, this isn't good enough, this is not Intel. These, mismanagement that's been going on while I've been away, I'm going to reverse that. Intel is back, very much beating his fist on his chest and using a lot of the throwbacks to Intel's prior leadership in terms of the messaging. But then what became clear as Intel reported earnings averaged like a 7% decline on the day after every earnings was released, because those earnings were showing margins narrowing, oh, and guess what? We're going to spend a lot of money to get us back. And so what's really going on is saying the right things, making the right decisions, arguably, but at the same time showing what the cost is and the amount of time it might take to get Intel back to leadership.
Hey, Ian, in a world where so much of the global economy is all about services, and certainly for the United States, we don't make a lot of stuff anymore, but the opportunity with a company like Intel where we actually make something, how important is that to the United States? And I think about, government intervention or government assistance here in making sure that we're still, making something in this global economy.
Yeah, I mean, if you are to view it from a nation-centric point of view, and Gelsinger is certainly one of those that does so the chip industry is enormously important. It's a fundamental piece of technology that underpins everything, and the U.S. That the ability to manufacture that is really centered in only Intel and a bit in Micron. Everybody else kind of doesn't do it anymore. It's done by Samsung. It's done by TSMC. Those are arguably the leaders right now. And what Gelsinger has argued and has, gained some traction with politicians who are listening to him, saying, look, if we don't have this, we lose that ability. It's not something you can just get back. It's based on knowledge. It's based on experience. And if that's going away, maybe it's gone for good. So he's really trying to do something about that.
And Ian, not unprecedented, right? Go back to, is it the 70s, right, where the U.S., there was a consortium to really help develop the U.S. semiconductor sector. So it's not unprecedented.
No, it's not unprecedented. And if you look at the numbers, Intel became the world's largest chip maker in '92. Up until 1990-ish, the US was responsible for sort of a third of production worldwide. Wow. Europe almost as much. Asia was just a third. Now that's massively changed, and that's a lot of money. But it's the know-how, I think, that people are much more concerned about. That once you lose that know-how, once you lose that experience, once that's gone, it's very hard to get back.
Ian, do you get the sense from your reporting that policymakers understand the importance of the chip industry to the United States? Do they understand what, does Intel and do Micron, do they get what they want from the U.S. government in terms of actual help?
I think there's two ways to look at this. You have an unprecedented piece of industrial policy, which is something that the U.S. just doesn't do before Congress right now. The CHIPS Act, $52 billion. Sounds like a lot of money. On the flip side, hasn't been funded yet. It's still stalled, and that's causing frustration amongst the chip industry. It's like, okay, so you've finally woken up, you finally get it, but A, that's not enough money, and B, you haven't even funded that. So yes and no, I think, is the answer to that.
Hey, Ian, I think about, investors who are listening to your conversation here and what you're saying. I'm just looking at what Intel was up about 3.4% last year. I mean, the stocks has been on a tear. So what do they need to keep in mind when they think about investing in or not investing in Intel?
Well, it's a very good question. Intel is the best performing chip stock this year. That's a very small sample size. We've had, 6 trading days?
Right.
That's based upon what Intel has said at CES, new products, we're coming back to leadership, we're going to do well, we're going to start taking back market share. Maybe there's a chance that people are getting behind Intel's story, that they're looking over the horizon and saying, hey, maybe Intel's back. On the flip side, we've got earnings coming later this quarter. The numbers there don't look good. The numbers look for revenue down again, look for profit margins under threat again. So it's a do you believe in the future? Do you believe in this management? Do you believe that they're not just saying the right things, but they're putting the company in a position to succeed? Because short term, it's not looking good.
Yeah, Intel actually one of my gainers. We talk about the markets a little bit later on. It's one of the few stocks in a lot of the selling that we're seeing today that's actually a standout. Ian, I know I say it a lot, but I really mean it, and we do. You're a must-read always when it comes to anything in the semi space. Ian King, U.S. semiconductor and networking reporter at Bloomberg News from our San Francisco studio. His story in the new issue, upcoming issue, the year-ahead issue of Bloomberg Business Week on newsstands later this week, online, and always on the Bloomberg terminal. Check it out. You're listening to Bloomberg Radio.
the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in the trading session. Caroline Hyde, Romain Bostic, and Shanali Basak, joined now by our colleagues Carol Massa, Tim Stenovic. Of course, we're bringing together our wealth of audiences, TV, radio, YouTube, to see, well, another day of tech selling, Carol.
Yeah, absolutely. What's interesting, though, Gina Martin-Adams, our chief equity strategist at Bloomberg Intelligence, saying what's interesting, though, about the trade today, Tim, in pointing it out, that we're seeing actually some broad-based selling. It's not just actually only technology. It's a lot of other sectors as well seeing some declines, even though we're off our lows here, Tim.
Yeah, off those lows, it's interesting. We talked to Sylvia Jablonski from Defiance on Quick Take Stock a little earlier today, and she said, hey, this is a great opportunity to go in and buy the dip, and it seems like we've actually seen some of that dip buying happen in the recent hour.
Maybe a bit in the equity market. And bond market, maybe it too got a bit of dip buying when you look at the 1.8% on a 10-year. But let's look at the majors, because still 125 members of your S&P 500 are only higher. 378 of them are in the red. That's why we dragged down by 6-10%. We're seeing the Dow off by 0.7%. Really, the NASDAQ as well, feeling the pain. Remember, it's off by 5.2% year to date, currently off by 0.8%. The Russell is your underperformer. The small cap's off by 1.1%. That's 24 points lower, Shanali.
And we should point out, too, that drawdown now in the NASDAQ composite right around 7.7, so rounded up to 8%.
Yeah, absolutely. And if you look inside the S&P, you were talking about the Dow being lower. We have industrials also lower, among the lowest of the day, 1.5% lower. Consumer discretionary, 1.5% lower. Of course, Tesla is in that category. We have one sector that is higher, and that is healthcare, less than 1%, about 0.6% higher on the day. So broad-based selling, but not everywhere, guys.
All right, well, you talk about the dip buying here, Tim. Take a look at Tesla here. The shares were down more than 4% here on the day, and they hit that 20-day moving average, and you started to see some of those orders come in. The share is now up about 1.4% here. A similar story for AMD. It hasn't quite turned positive, but AMD was down as much as 5% here on the day, hitting some of those key technical levels, and you start to see a little bit of a bounce. It's now only down 1%, and you talk about healthcare. Gilead Sciences, it's pretty much been in the green all day long, up about 0.8%, and probably the star of the day is going to be Zynga here. Interesting acquisition. Take-Two agreeing to buy the company in a cash and stock deal. Those shares up about 42% at 854. It's a 986 deal. When you factor in debt here, that gets you to the 42%. Still, it's about 60+% above where it closed on Friday.
A little bit of opportunities still being taken, risk-taking somewhere when it comes to M&A. But really, this is a story of how we're starting to see the rate environment change here. We're looking at a flattening yield curve on the day with twos going up, yields up 4 basis points. Your 10-year, managing to get a little bit of a purchase at 1.8. We're now back at 1.77%. But look at what's happening in terms of your negative yielding debt. This is Europe actually really doing most of that particular drawdown. You now only have $10 trillion worth of negative yielding debt. The first time in 20 months. Is that a buy?
I like the only. Listen, we're going to be talking a lot about inflation this week. We've got that CPI print on Wednesday, and we'll hear from Jay Powell, of course, as well. Meantime, Bill Dudley, former president of the New York Fed, he's now a Bloomberg opinion columnist. He's also an advisor to Bloomberg Economics. He thinks the Fed's already behind the curve. Here's what he had to say.
They have inflation melting away to 2.1% in 2024, even though they don't take monetary policy to a tight setting. The end of 2024, the federal funds rate is 2.1%, below what they think is neutral. So how does the inflation magically disappear if the Fed Reserve is actually not making monetary policy tight?
All right, that, of course, is Bill Dudley, former head of the New York Fed and a Bloomberg opinion columnist. Romain, I feel like that's a question that we've all talked about. Like, how do you make the inflation disappear, especially as wages go up?
Yeah.
That sticks around for some time.
That's certainly a debate to be had. I guess, too, it's also how does the market react to that? I mean, I thought Dudley's comments were interesting, but then you put that into the context of the notes that we had out overnight from Goldman Sachs and Jan Hatzius, the idea of maybe, I guess, what would be considered a slightly more aggressive position for rate hikes this year. And then you had Wade Lindsay over at BlackRock saying, this isn't necessarily bad for stocks. You may get a more aggressive Fed, but that doesn't necessarily mean everything sort of comes down. This is a reset here, and maybe this drawdown is what it takes here to get to reinstill more confidence.
It's also, though, will we hear any confidence or lack thereof from Fed Chair Powell tomorrow when he goes in front of the Senate? Of course, we're seeing him basically trying to reapply for the job that he already has. But Tim, I'm interested in what he says about Omicron. Today, we started to have that double-pronged effect, the worry that Lululemon is talking about, that some of the other key companies, that actually Omicron is taking a bite out of, whether it's their supply chain, their labor issues. It's not looking pretty out there.
Yeah, it's not looking pretty out there for some companies. Lululemon among those, getting a little preview of the quarter that ends at the end of January and the stock taking a hit there. I wonder, though, what it means for other companies. We're going to hear from Delta Airlines on Thursday, and I wonder how they're doing with terms of these flexible cancellation policies. Are people saying, okay, well, this is the world we're going to be living in, so we're going to fly, or are they going to cancel their tickets and not go on these trips?
Well, going back to the Lululemon thing, I thought it was interesting how much of that was basically labor issues, and they pretty much made that clear. I mean, they dealt with some supply chain issues, but it was so much labor, and I feel like we're going to hear this from so many companies this earnings season, that really was the story, particularly at the tail end when Omicron really started to rear its head.
Right, it's truly the moment of truth, because if you have input costs going up all across every level here, have investor expectations been a little bit too rosy walking into this earnings season?
You can't even walk into a Lululemon store. They said they had to reduce hours.
Yeah, look,
this is why I still haven't bought those tights.
It's not just...
It's just fine, Romaine, if you'd like to pick up.
E-commerce can serve your leggings.
Hey, I'm going to jump in here and give a shout out to Sean Donnan, who, along with some other colleagues from Bloomberg Economics, wrote a great piece that talks all about the Omicron disruption that we're seeing when it comes to labor. I said this on the radio earlier, guys, but the labor shortages that we're seeing due to Omicron, a friend and I were talking about it, and she said, this is like the new supply chain, right? A company's, an actual store is closed due to people being out because of sickness.
But does that mean then this is going to be more temporary than maybe what we saw with the supply chain issues?
Well,
that's the hope.
Well, and this is what, do we look through COVID? Bloomberg Intelligence, estimating that we're going to see earnings growth in the S&P 500 of 20%, and that should be supportive of more gains in the stock market. Not maybe like we saw last year, but Caroline, still some gains.
Still some gains. I wonder what it means, though, for the health of the consumer as well. Where is the read of that? People aren't turning up to work. Are they buying their services? Are they still managing to be spending as much as they always have done in terms of e-commerce? Where is that side of confidence at the moment, if indeed we are seeing significant amount of labor issues simply because they're not well, let alone scared of going into work?
Well, with wages rising, and then we know that consumers are levering up again, that's got to be a good sign, at least for the beginning of this year, because people are putting on their credit card balances again and ready to spend.
That's a really good point. And when we hear from the banks, we'll get even more clarity on all of that. Shanali, thank you so much. Everybody, thanks. We're going to be back at 4 p.m. Wall Street time for Beyond the Bell, our cross-platform coverage on radio, on TV. We're going to take you through today's market close on this Monday.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic here on Bloomberg Radio. So, yeah, it's going to be another interesting week. I feel like if you think about how things were in terms of last week, we got so much information, a lot of market volatility. I mean, the VIX is up another 2 points today. We're certainly way off what we saw in terms of December, but nonetheless, there's a lot out there that can really move the markets this week.
Yeah, there is. Starting, with not only what we heard from companies today, right, Carol? The M&A news, and we heard the Lululemon news, but also what we hear from Fed Chair Powell tomorrow when those hearings begin. And then, of course, CPI coming on Wednesday. We thought 6.8% was an increase, right?
Right, 7. We're talking about 7.1%.
7.1,
but again,
that's what we're expecting to see.
Is that a peak? Like, are we getting near a point where there's a peak? And how much of the inflation and those inflationary numbers stick around with us, and for how long?
But are we going to ask the same question in a month from now? Are we getting close to a peak?
I don't know, right?
Yeah.
Or does it stick around? And I guess some of it's really dependent on the pandemic. I mean, Bill Dudley, obviously, I feel like he's the new Cheshire Cat, if you will. I don't know whether there's a Alice in Wonderland character that you can link up with the Fed or Jay Powell. I'm not going to go there. But it is interesting to hear what he has to say, and just being pretty tough in saying that the Fed's got to be a lot more hawkish. Having said that, even if the Fed does, 4 rate increases, whether it's a quarter of a point, whether it's a half a point.
I know where you're going with this.
And that gets us up to 2%. We're still really low on a historical basis.
We are, but it does also mean that interest rates go up, of course. As a result, we see interest rates go up on credit cards. We see interest rates go up on mortgages if the 10-year rises in accordance with that.
And does maybe the Fed, maybe even the administration, some provocative theories being put out in some of the stuff on the Bloomberg today about, does maybe the administration want to see things slow down? Because that would certainly help out the supply chain disruptions.
Well, that's a good point. And I think also, I thought a lot over the weekend about what Caroline talked about late Friday when we were speaking to her as part of our simulcast in the 4 p.m. hour. The question about inequality, because we saw the Fed change its position in terms of how it thinks about its dual mandate, right? Stable prices. And also thinking about the idea of that including, that including a recovery for everyone. Not
Wait,
what
say
we
that
saw.
again?
Yeah, so if we think about what the Fed's dual mandate is, right?
Right.
Stable prices and maximum employment.
Right.
We saw the Fed over the last 20 months change its thinking around what exactly maximum employment means and who that means maximum employment for.
Right.
Different sectors of the economy. We learned in the jobs report on Friday that this is indeed an unequal recovery, and you have to wonder how hot the Fed is going to let inflation run in order to make sure that every element of this economy recovers and not have a repeat of what happened after the great financial crisis, which we know President Obama and President Biden regret.
And let's remind everybody, there isn't a triple mandate. It's not about the financial markets, but the Fed does, safe to say,
they pay attention.
Many smarter people than me would say that the Fed certainly watches the financial markets. And also safe to say that Jay Powell has been very deft in terms of handling the messaging in terms of the markets. And so you do wonder, if they don't raise rates, will there be significant disappointment and we'll see a little bit of a tantrum in the markets? This is the messaging
in the bond market or in the equity market, both?
I don't know. Do we get that 2% on the 10-year? We're getting closer and closer.
Who was it last week who told us 1.75 on the 10-year?
We got 1.8 today, didn't we?
I know. He said by the end of the year.
We're keeping an eye on it. Lots to cover this week. You're listening to Bloomberg Radio. All right, you are listening to Bloomberg Business Week. Carol Master along with Tim Stanovic. One of the things that's interesting, and we're going to talk about this with our own Andy Brown of Bloomberg New Economy. He's got a column he wrote this past weekend. But the Beijing Olympics are less than a month away.
Yeah, how are they going to deal with COVID already affecting athletes? And you have athletes that are already out of actually preparing in some instances because of COVID, and some people who can't even qualify, Carol, because of COVID.
It's tricky. And what's interesting is, too, how Beijing will be viewed. You go back to their first Beijing Olympics, right? And it was a powerhouse. I think it's safe to say that so many people were impressed in terms of the people on the field, the magnitude, the size, the production. It's very different this time around. And the backdrop also includes Omicron arriving in a port city that borders Beijing and spreading inland before Chinese officials detected it. And so, this whole COVID zero policy, China is very much, trying to keep this contained, locking down their society as soon as they see the virus. But for it to get so close to Beijing, that's a little worrisome.
Yeah, so let's talk numbers here. There have been 21 new locally confirmed COVID infections in the city of Tianjin after 2 Omicron cases were found on Saturday. That led to closing schools, halting travel, and mass testing over the weekend. What a difference, right? And the approach around the world. You have China closing schools and doing mass testing over 21 cases. Here we are in the United States where there are hundreds of thousands of new cases every single day, and we're trying to get through it based on 5 days of quarantine.
Right, exactly. And they've got this COVID zero, policy where they lock down things in hopes to contain it, and yet it's still tricky. And so what does this mean for President Xi? Politically, he was looking to really mark himself as the longest standing, head of the party there. This has been pretty significant for his run.
What does it also mean for different areas of the country that face lockdown measures and face production challenges, supply chain issues as a result of this?
Exactly. And, tick-tock as we count down to that Beijing Olympics. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Less than 43 minutes to go until the closing bell. Elevated long-term interest rates, that has been one of the factors bedeviling the equity market today. Good news is, if you're long this market, we are off session lows. Let's get to the Bloomberg Macro Squawk Desk for the latest, and Bill Maloney. Hi, Bill.
And good afternoon, Doug. That's right. U.S. stocks under pressure today, but like you said, well off of session lows. Dow's currently down 322 points. S&Ps are down 37, while the NASDAQ drops 137 and was down 400 at one point. The U.S. 10-year yield at 1.78%. Gold is up 4, and Bitcoin is down by 2% after an intraday plunge. Among the main 11 S&P sectors, only healthcare was in the green. Industrials and consumer discretionary went under pressure. And leaders to the upside in the Dow, Intel and Merck, while Boeing and Nike led to the downside. In deal news, Take-Two to buy all the outstanding shares of Zynga for $9.86 a share. And in other news, Tiger Global lost 7% last year for the first annual drop since 2016. Also, Bristol-Myers is buying back $5 billion in stock. And wrapping things up, Accolade reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Doug?
All right, Bill, thank you. To get live audio updates right on the Bloomberg terminal, the function is SQUA, then the green go key. We'll check markets again in 15 minutes. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, really appreciate it. Well, Omicron has flared in a Chinese port city that borders Beijing and spread inland, seeding the variant on the doorstep of the nation's capital less than 1 month before the Winter Olympics in Beijing begin. And we know, Tim, pulling off safe games will be a big test for President Xi.
Andy Brown is editorial director at Bloomberg New Economy. He joins us on the phone from New York City. Over the weekend, Andy, you had a column out that was titled China's betting on Olympic victory over COVID. This was New Economy Saturday. Since then, though, we've learned more about community spread in China. What do we know about how Omicron is spreading in the country? And give us an update on its COVID zero policy.
Well, what we know is that there are 40 cases in Tianjin. Tianjin is Beijing's port city. It's less than 100 miles from the Chinese capital, half an hour on a train. That outbreak has leaked into Henan province to the south. Henan is right now battling a Delta outbreak. Both Tianjin and Henan press up against Hebei province, which is where many of the Winter Olympic ski and skating competitions, luge competitions, are taking place. This is really Beijing's nightmare. I mean, it has profound implications for the Chinese economy, for global supply chains, and indeed for domestic Chinese politics. This is an incredibly sensitive year when President Xi Jinping, at the end of the year, is seeking a third term in office at the 20th Party Congress. And, you know, China's success, his success in defeating COVID is a big part of his program this year.
I mean, basically, Andy, you write that his political credibility and China's political credibility really at stake here.
Yeah, so, you know, they presented and look, China defeated Delta. It's an extraordinary victory. You know, they talk about a people's war, and they've compared and contrasted their success against COVID with America's failures. So they say, you know, propaganda, sort of nationalistic, chest-thumping propaganda. Look, the American democratic system has completely failed. 800,000 people, you know, died in the United States. It proves the superiority of the socialist system. And look, you know, here it is in China. And if they can't contain this, and it looks it's going to be a really difficult job for them to hold to their zero COVID policy, given that Omicron is, you know, by some accounts 70 times more infectious than Delta. It really seems that this is an uphill battle for them.
Mm-hmm. Yeah, it's one thing to be able to do this if borders are closed and you're not holding an event that attracts people from all over the world. Still, though, they are putting into place some huge restrictions when it comes to the Olympics. How are they trying to prevent this becoming a super spreader event? And indeed, even one case is too many for the Chinese government.
Yeah, so the Olympics is going to be held in a bubble. I'm actually going, and I'm going to be part of that bubble. So we won't be allowed out of the venues and the
Can you
hotels.
call us from
We'll
there?
be allowed to wander around. I can indeed.
Okay,
absolutely. But you know, it seems to me, and I'm not in any way a medical specialist, but it seems to me almost a certainty that you're going to get Omicron outbreaks in the Olympic Village among the athletes. It could well knock out individual athletes. It could even knock out whole teams. It really does, foretell some chaos during the games.
Yeah, you do think about, Andy, fingers crossed that things improve and everybody who goes, including yourself, are safe and that the numbers go in a different direction. But you do wonder if it doesn't go well, what could be the implications? I mean, what could be the longer term implications for President Xi going forward if things don't go well?
Well, there's the economy that he has to think about.
Yeah.
So, to defeat COVID, they've had these rolling lockdowns, they've had travel restrictions, it's disrupted ports, it's closed down factories, it's dampened domestic consumption, and growth is slowing. And economists, even before this Omicron outbreak, the economists had been downgrading Chinese growth forecasts for next year, or rather for this year. And of course, with a knock-on impact to the global economy through supply chains, many of which, of course, run through China.
I do wonder, though, what has more of an effect on supply chains, the closing of something because of COVID, or, just people not showing up to work because they are sick, Andy. So it's like it's hard to imagine a scenario where this doesn't have an economic effect, because even a COVID-0 policy that includes lockdowns, mass testing, and school being canceled, that has serious economic implications.
Absolutely. China did very well in 2020 and 2021 when rich countries were all in lockdown and people weren't buying services, they weren't going out to eat, they weren't traveling, they were buying goods, and these goods were made in China. Well, if Omicron turns out to be as mild as we hope it will be, that situation could reverse with implications for China's exports right at a time when domestic consumption falls. This is really the worst of all worlds for China.
God, it's so tricky. All right, Andy, thank you so much. Bloomberg New Economy Editorial Director. You can sign up for the New Economy Daily Newsletter at bloomberg.com/new-economy. This is Bloomberg Business Week. Chart of the Day coming up right here on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Can I quote you?
Sure. Yeah, please.
Tim's a little nervous. He said,
I don't know where you're going with this.
This chart of the day that we're going to do, he says it looks like a Christmas tree.
Yeah, a lot of red, a lot of green, okay? I'm still thinking holidays here. We took our Christmas tree out over the weekend.
We did too.
Yeah. You have that vacuum cleaner full
It was a little
behind,
crunchy.
right?
There were a lot of needles on the floor. All right, Kriti Gupta is going to join us in just a moment. In the meantime, let's get back to the markets. Get back to Doug Krisner with a look at that trading day. Hey, Doug.
Hey, did you see my Nike shares today down more than 4.5%?
Ouch.
Yeah. Well, HSBC downgraded the stock
Investors
today.
running from Nike.
I see
Get
what
it?
she did
Yes,
there.
I get it.
Sorry.
You don't have to laugh, Doug.
Is that the writer's room that you participate in every morning?
Doug, I used to love you. Yeah.
That's all right.
All right, take it away.
So HSBC was looking at demand in China, and the view here is that it's going to remain lackluster. And the other thing that's noteworthy is that HSBC is looking at price action in the currency market and concluding that this is not going to be necessarily beneficial for what we're seeing play out in Nike. Stronger dollar, probably one of the factors. So the stock is down more than 4.5%, and that is leading consumer discretionary lower. As a result, the S&P down about 0.7%. I want to point out, though, that the S&P had been off by about 2% earlier. NASDAQ comp down 0.7%. And where the Dow is concerned, a loss of about 0.8%. So generally speaking, long-term interest rates remain elevated today, and that is challenging the notion that some of these stocks with high valuations basically deserve to be valued at this level. Market is kind of doing a bit of a rethink on that front. And we have, in small cap space, the Russell 2000 down a little bit more than 1% right now. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, thank you so much.
Let's bring in Kriti Gupta now. Each day at this time, we check out her chart of the day. And I'm sorry, Kriti, I don't know if you were listening earlier when Carol made fun of me, but I did see that my first thought was, still the holiday season when I saw this chart. It's about dollars not fueling stocks, the inverse correlation between a dollar and S&P 500. It's fading. But for those of you listening on the radio right now who can't see it, it's a lot of green and a lot of red.
It is the holiday spirit. I just won't let go. Although I will say I did take my Christmas tree down the day of New Year, like New Year's Day.
Oh, you're one of those people.
Tim and I both
actually
just did it. Oh, okay.
You just felt like you just had to do it?
This time I was just like, you know what? It didn't feel like the holidays to me.
Yeah.
So, I was just like, you know what? I'm going to just take it away.
We all felt that way a lot. And I know you were away from family, so it makes it even harder. I know. All right, before we all start crying, let's do the chart of the day.
Do the chart of the day. Yeah, so I'm looking at what Tim calls a Christmas tree chart, what Tom Keene call a red zone green chart. I call it a regular correlation chart. Essentially, it shows you the 66-day correlation between the stock market and the dollar. And really what it's showing you is that this is what Tim was talking about. There's a lot of red, which means that there's a lot of inverse correlation, which means that when the dollar is weaker, the S&P 500 tends to be higher, or you tend to see kind of people buy into the S&P 500 because it means that they're doing so at a cheaper level because the dollar is weaker. And it kind of works the other way too, that if the dollar is stronger, the S&P 500 would probably get less of a bid because it's kind of expensive to access. And this affects mostly foreign investors. This was a really big deal in 2020 and for a good chunk of 2021 where you didn't really have that kind of certainty around the Omicron variant. So the kind of knee-jerk reaction was to hop into the safest asset in the world, and that happens to be the U.S. dollar, U.S. Treasuries, and the S&P 500, specifically big tech.
So help me out for a second. Hang on, wait. Yeah. Okay, and Ari, Ari's our producer. Keep it up, the chart up on YouTube, and sorry, everybody on radio. But what we've got is like up green, down red, up green, down red, up green, down red. Right, and we're going back to, where does this chart start?
2015.
Okay, so the green signifies what, and the red signifies what?
Yeah, so the green signifies a positive correlation. The red signifies a negative correlation. And really all you kind of need to know is that for most of 2018 and 2019, we were in the red. A lot of that had to do with the trade war. For most of 2020 and 2021, we were also in the red because a lot of that has to do with the Omicron uncertainty that I was talking about. That being said, it's starting to fade, which means we're starting to get closer and closer to the green zone. We're starting to get turned positive, which tells you that perhaps there's a little bit less of an appetite from investors around the world who are looking to enter the S&P 500. Well, they're not really paying attention to the dollar to do that, which tells you that maybe they don't have that desperation to get into U.S. stocks as much as they did in 2020. Essentially, it's a pretty good sign. It tells you things are going back to normal.
FOMO, Tina, I'm just going to say. I'm going to put those acronyms out there. Because I think ultimately it's going to figure, I don't know, there's a lot of things that are at play here, right? We're going to see potentially division in terms of different central banks doing different things, but I do wonder about the growth metrics, the potential for earnings in different markets around the world, and where investors will ultimately pay up, you know, to have access and exposure to the growth.
Yeah, well, here's kind of the good news of that, right? Ordinarily, when there's kind of this desperation, essentially, to hop into the dollar or hop into stocks, it means that something's wrong, right? It means that there is something going on in the world that you essentially need to find kind of this shelter bid. And right now, you're not really seeing that. You're seeing the dollar strengthen. You're seeing stocks, well, not today, but before this kind of sell-off that we've been seeing, but you were seeing stocks strengthen. And when you see that, but they're not correlated to each other, it actually signals that the economy is growing underneath, that people are buying the dollar, not to spend it, but because they believe that the U.S. economy is growing, which is what you want. You want things to be based on fundamentals.
Well, that's something Gina Martin Adams talked about right at the top of our broadcast with you, and this whole idea of that, you know, the reason we're also seeing, you know, the Fed be willing and able to raise rates has to do with economic growth.
And hey, we're going to start to get some of those fundamentals in just a few days when we hear from the big banks. We hear from Delta Airlines on Thursday, and then
You're
earnings
keen to
season
hear from
gets-
Delta,
I
aren't
really
you?
am. It's the
I
first of the big
know.
airlines, and you know the
You got
reason
Delta
is
Miles or something?
no, you know, in this day and age, because of COVID, we kind of just threw our hands in the air, and we're not. We have no status on anything. But my wife did fly Delta over the weekend, and she said it was 25% full on her way to Cincinnati and on her way back from Cincinnati. Granted, she did tell me nobody's flying to and from Cincinnati right now, but for what it's worth.
We love you, Cincinnati.
And she
just
was able,
so you know.
and her flight wasn't canceled.
Yeah,
she was
which
able
is
to
a
get
good
there
thing.
successfully,
There were
which
people,
is great.
right? There was crews that could actually fly it.
Exactly, that's a big deal. Hey, should we talk about tending to the farms?
Yes.
On Farmville?
Deal
Creedy,
flow.
Creedy, were you back in the day? Did you like Katie Greifeld? Did you have your laptop open freshman year of high school and you were tending to the fields of Farmville?
You know, I didn't, but
I didn't either.
I did cover video games
Oh, okay.
during my first couple of months at Bloomberg.
Oh, I didn't
It was
know
very
that. That's cool.
sweet. Yeah, I was on the video game and marijuana beat, which was natural for a girl of my stature.
Okay,
it was crazy.
Wait a minute. That's like the elephant in the living room. You think you're going to get away with that? You got to explain. No, okay. We'll talk about that later.
I think this was probably a big deal. Then today's a big day for you, though, because it takes you back to the video game, the big M&A.
It does. It was my first beat at Bloomberg. I was covering video game stocks and marijuana stocks. Those were my two beats. And I actually got to go to the Red Dead Redemption 2 launch event back in the day when I was interning. So this was a really huge deal when I saw that Take-Two is actually looking to buy Zynga. Essentially, Take-Two, for those of you who aren't familiar, is a parent company that makes Grand Theft Auto, Red Dead Redemption. These are two really big video game franchises, and they're looking to buy Zynga, which, of course, to Tim's point, makes Farmville, but also makes Words with Friends, which is the one that I'm more familiar with. And what's interesting here is that they're doing it to kind of hop into the mobile gaming sphere. Remember, video games have been under a lot of pressure after 2020. People are going back to school. People are working. There's also this crackdown from China. So these stocks have had a lot of pressure, and they're also seeing some of their kind of value getting eaten into. And the video game market as a whole is kind of split 50-50 right now between traditional PC consoles and 50% with kind of mobile gaming on the go. So this deal actually combines the two. It brings them together in an $11 billion deal, which I should say Take-Two is paying top dollar for. Yeah. That's the equivalent to about 5 years of their revenue. So making a really big bet here.
That's big exposure. But if you think about it, I know I play some games. I love the New York Times, like puzzles and things like that. I mean, these are things that I think
much cooler than us, Carol.
I'm not really. Was there sarcasm in that? I just want to know. But I mean, I do think about, right, there's a lot of this going on. We are playing a lot of games on our mobile phone.
Yeah, and especially in this generation where, and this is why mobile gaming has actually seen a lot of success, because we are moving, we're waiting for, travel, we're going on the subway, taking it with us. There's a lot of momentum and I should say a lot of monetization involved in that.
All right, good stuff. Thank you so much. Kriti Gupta joining us with her chart of the day and also a look at that M&A flow. Take two, buying Zynga. You're listening to Bloomberg Business Week on Bloomberg Radio. And you are listening to Bloomberg Business Week. Carol Master along with Tim Stenovic here in our Interactive Brokers studio live at Bloomberg headquarters in New York City. There is a story by Michael Leonard and Janet Lauren, and this has to do with more than a dozen top U.S. colleges, including Yale, Columbia, and MIT, being sued for allegedly conspiring to manipulate the admission system to hold down financial aid for students and benefit wealthy applicants. Man, this story is
a big one.
A big one.
So let's give some details here. The proposed antitrust class action lawsuit was filed Sunday in federal court in Chicago. It accuses the university, quote, cartel of a long-running scheme to collectively adopt, quote, a common formula for determining an applicant's ability to pay tuition, end quote, rather than competing freely over financial aid by trying to attract students through more generous aid offers.
Right. At the same time, more than half of the schools have given preferential treatment to wealthy applicants by tilting the scales to favor the children of, quote, past or potential future donors, end quote, through a largely secretive practice known as enrollment management, according to the complaint. We got to read through this story.
So besides Yale and Columbia Universities and MIT, the defendants in the suit include Brown, Caltech, University of Chicago, Cornell, Dartmouth, Duke, Emory, Georgetown, Northwestern, Notre Dame, University of Pennsylvania, Rice, and Vanderbilt. The schools are allegedly acting illegally and claiming an antitrust exemption under Section 568 of the Improving America Schools Act of 1994. The exemption applies only to schools that practice need-blind admissions, according to the lawsuit.
Yeah, I mean, it's kind of interesting. And so, some of the richest U.S. colleges describe themselves as need-blind in admissions because they don't examine the finances of a family as a consideration before admitting the applicant. In order to qualify for need-based money, families must fill out long questionnaires about the finances. Having gone through this process recently, right, we often hear need blind, like you apply to the school, we're not going to look at whether or not you need financial aid. This is exactly what this speaks to.
Hey, we should note that Dartmouth, Emory, Notre Dame, Duke, Northwestern, Cornell, Rice, and the University of Chicago, they declined to comment on the pending litigation. We did hear from Yale, Brown, Caltech as well. Yale spokesperson says that the policy is fully compliant with all applicable laws.
All right, you do wonder what this will mean ultimately going forward for students.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
All right, you're listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic in our Interactive Brokers studio. Quick check on the markets. After what a wild week last week, we are seeing more pressure on the equity market, but we're definitely off our lows of the session, still down about 244 points on the Dow Jones Industrial Average, a decline of 0.7%. S&P 500 down 21 points for a decline of just about 0.5%. And the NASDAQ doing the best, outperformance on a percentage basis, just off about 0.4% or down 60 points. Tim, we've definitely seen a bounce back when it comes to the equity trade.
Yeah, absolutely remarkable to see these dip buyers come in, especially at a time when the NASDAQ was down more than 2%. Hey, let's not forget about the Russell 2000, which was down more than 1% earlier in the day, down about 0.8% right now. As far as decliners and advancers going on the S&P 500 and on the Dow, on the Dow we see 8 stocks moving higher and 22 moving lower. The S&P 500 we see 131 moving higher and 372 moving lower. And the NASDAQ, close to 1,000 stocks are higher, but more than 2,200 are lower. So not as broad-based of a decline as we were saying earlier in the day, Carol.
No, exactly. And interesting to see, and as we heard from Gina Martin-Adams earlier, a lot of broad-based selling. It wasn't just about tech, but what we've also seen is a fair amount of buying as we see those equities move off the lows. Let's get to the drive to the close. Anu Gagar is with us, global investment strategist for Commonwealth Financial Network. She joins us once again on the phone in Waltham, Massachusetts. Anu, great to have you here with us. Happy New Year. What a year it's already been in 2022, which is kind of funny for us to talk about this. How much do you pay attention to what's happened in these first 5-6 trading days of 2022? You know, we talk about the first 5 days indicator, and some market watchers watch that pretty closely. Do you?
Carol, Kim, Happy New Year to you as well, and thank you so much for having me here. So, you know, the saying goes that January goes, so goes the year. So, you know, to that extent, of course, you know, we are watching markets every day, but of course, we're not really making any predictions on, you know, a one-day move or a 10-day move, so to speak. But yeah, you pointed to the market reactions today. What a day. Who would have thought when we started the day this morning that the NASDAQ composite would actually be one of the best performing major composites, major indexes to end the day.
Yeah, so what happened here, it's really funny. I mean, we're on the NASDAQ, they're barely down not even down 0.4%. We were down more than 2% earlier.
Yeah, so looks like there is some technical buying coming in by, you know, the buy the dip sort of traders, but really the equity sell-off today and in the first 10 days of 2022 is just a market reaction to the FOMC meeting minutes that reinforced the Fed's resolve of a hawkish pivot. Omicron or not, the Fed is on a path to tapering, and now the debate is whether it is 3 rate hikes next year or 4 or more, and the speed of balance sheet runoff.
All right. You know, the thing is, it's just at this point, even if we get, 3 or 4 rate increases, it speaks to a growing economy. It speaks to earnings growth. Gina Martin-Adams reminding us of our Bloomberg Intelligence team that they're looking at 20% S&P 500 earnings growth this year. That's significant. You know, we might get some recalibration of multiples out of that because of the run-up that we've already seen, but nonetheless, it's still growth. How do you see this maybe recalibration in the equity trade playing out this year? How do you make the bets at this point, or do you wait a little bit?
Well, overall, I think risk assets are still resilient as liquidity conditions remain easy, and economic growth, as you pointed, is also a tailwind. And when starting from such low rates, higher interest rates are not necessarily negative for equities, and equities could prove to be an inflation hedge to an extent. But of course, higher interest rates do pressure profitability and valuation multiples. For consumers, it reduces spending power. So I am expecting a more bumpier ride in 2022 and lower returns.
Well, what's interesting,
given last 2 years' lights out performance, that may not necessarily be alarming.
Right, exactly. Like perspective, everybody. It's interesting. There's a great chart. I'm going to talk about it. I didn't want to give it away, but I think I'm going to do it with our Beyond the Bell team. I've been dying to talk about it all day. We've got a write through on the markets, and it cites some research from Strategas Securities, and they say in the past 3 decades there have been 4 distinct periods of rate hike cycles by the Fed. On average, technology, which has been under pressure, as we know, in this first week of 2022, is among the best performing sectors during those Fed rate hike cycles. So, what are your thoughts about that? And that's according to their research.
Yeah, well, if you think about, Carol, what has really been driving technology sector and the broader market in the last few years, it's really been those very big large cap growth names. So, you call them FANG or FANG, whatever it is. But most of these companies, they tend to have, better visibility in their earnings. They don't have quite as much leverage. So even with higher interest rates, we talk about how it can impact higher duration stocks. Those are stocks that either have higher leverage or they have earnings coming way into the future. So those are not these large cap growth names.
So raises the question on what we should be keeping an eye on right now. And here's what's interesting. I'm playing around on the Bloomberg, and I'm looking at ARK, Kathy Wood's ARK Investment Management, right? The ARK Innovation ETF, a lot of the high-flying stocks. And I like to check that out when we do see some broad selling off in the NASDAQ, because the companies that she has in that are those ones that she calls disruptive technology stocks. This was down more than 5% earlier in the day. It's now flat on the day today. What gives?
Yep, that's right. So as I said, there is a lot of buying coming in from all the technical pressures. A lot of stocks are hitting those 50-day or 200-day moving averages and getting some buying support coming in at those levels. So not surprising, because those higher flying stocks, of course, they bore a lot of the brunt in the early days. So not surprising for them to find at least momentary bottoms.
So where would you be allocating new money at this point?
Well, I would be more diversified at this point, because, of course, it's not a surprise that we are expecting higher interest rates. So in a higher interest rate environment, financials, particularly banks, tend to do better. So that is certainly an area that I do find attractive, but also the large cap tech names that have declined with the rest of the market, and those higher flying names, I think they can get quite attractive as well.
Okay, so help us think about where else our audience should be thinking about in terms of where they're putting their money and asset allocation for 2022. We haven't talked much about fixed income, and I'm wondering if you see a place for that in a portfolio still.
Yeah, so fixed income, it's even trickier, with expectations of rates rising. Certainly don't want to be in those very high duration fixed income. So I would still keep it mostly shorter duration at this point.
So I'm sorry, you said you should have exposure to shorter duration?
That's right.
Yeah, what's the surprise that you think might catch investors off guard, especially when it comes to fixed income? And we've already seen a big move up in yields at this point. It's safe to say that we've been recalibrating in terms of the expectations about Fed policy. Are you anticipating that the Fed is a lot more aggressive than everybody is anticipating?
That is quite likely. The Fed starts to get aggressive, and especially if it starts to become clearer that the Fed's behind the curve, and we start to get start to see indications that the Fed might actually hike more than 4 times, or might let the balance sheet run off much quicker and start much quicker on balance sheet runoff.
All right, we're going to leave it on that note. Anu, thank you so much. Really appreciate it. Anu Gagar, Global Investment Strategist at Commonwealth Financial Network, on the phone from Waltham, Massachusetts. And as we say that, we did see the NASDAQ 100 just blip into positive territory, just barely. Here we are with just a few minutes left in today's trading session. But we have seen buying on the dips today in a big way because we are at our best levels of the session. S&P now just down about 11 points. The Dow off still 194 points, and the NASDAQ just down about 6. So we have seen a significant bounce back when it comes to today's trade.
So
are you laughing?
Yeah, I'm laughing. Like, what does that mean for the week and moving forward? Does it mean that we kind of ignore the activity today?
No, no. I think it's interesting to show that investors are like, wait a minute, I see some opportunities out there, and that they are buying here into the close. All right. We're going to be joined by our Bloomberg TV team for Beyond the Bell live on Bloomberg Radio, YouTube, and on Bloomberg Television. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here, Caroline Hyde, Shanali Bassett, counting you down to the closing bell. Here to help take us beyond the bell, our global simulcast partners, Carol Massar and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences. And Carol, I had all kind of superlatives lined up to talk about just how bad this market was. And here we are. It looks like we're about to turn green.
You know how after all the holiday shopping, you get all these emails, on sale, on sale. Well, that's what it feels like in the equity markets today. Things were a lot cheaper than they were at the end of 2021, Tim, and you saw a lot of buying here on the dip.
Yeah, one of those things that was a lot cheaper was ARK's Innovation ETF, ARKK. It was down more than 5% earlier in the day. The dip buyers came in, it's higher by more than 0.1% right now. It actually hit a new 52-week low earlier in the day today, but it looks like it's going to close higher, Caroline.
Yeah, and looking at also where perhaps some buying came in was how oversold potentially we got on the US Treasury. You know, we saw the 10-year, the yields were, well, spiking higher and up 1.8% at one point. Then in comes some of that buying. We're now seeing a yield of 1.77%. But really, it's been yields that drive the tech sell-off. And when that steadied, maybe we got a little bit more, well, desire to buy in.
Yeah, it's a real dance here, Caroline, between a policy mistake and something that could actually be good for the markets at the end of the day as investors clamor for some rationality.
Yeah, and I mean, look, I think you have to also go back to some of the market commentary that we've gotten out of a lot of folks who seem to suggest that, look, this isn't necessarily going to be bad. The tightening is still done within the backdrop of a strengthening economy. BlackRock's Wei Lizzie kind of pointed this out in a note, saying that when you look at valuations and you overlay that with some of the moves that we're seeing or potentially seeing in the federal funds rate, it's not necessarily going to be that bad. All right, here are the closing bells here, and we got a lot to parse. We'll just go through them real quickly and then circle back around. The Dow Jones Industrial Average is going to finish the day roughly down about 0.5%. It was a much worse day here for the Dow a little bit earlier. And let's stop for a moment. We're getting some news here. Fed Vice Chair Clarida to resign from the Federal Reserve Board on January 14th. Of course, we know that Clarida had planned to step down, or his tenure was over at the end of January 31st. We're now getting headlines right now, Caroline, that he plans to step down from the Fed board on January 14th. Let's go right over to Bloomberg's Michael McKee, who's standing by right now, our Bloomberg International Economics and Policy correspondent. This is a surprise, Mike, is it?
It's definitely a surprise. Clarida was expected to leave the Fed on January 31st when his term runs out as governor and as vice chair, but decided to resign early. It appears likely that his decision comes from the new reporting on trading that he did as a member of the Fed, trading in stocks. He sold a lot of stocks on the day before the Fed announced many of its rescue programs back in 2020, and then bought them back. And gives the appearance, even though nothing's ever been shown of impropriety, but gives that appearance. And he originally did not put that in his financial statement, but at the end of the year amended that, and that was reported, and it does look like that he is now joining Robert Kaplan, the former Dallas Fed chairman, and Eric Rosengren, the former Boston Fed president, in resigning because of this trading scandal. His resignation letter does not mention a reason. He talks about his pride in working for the Fed, but one would assume that that is probably behind his decision to go 2 weeks early.
So maybe appeasing some detractors there. Meanwhile, though, Chair Jerome Powell sort of coming out in support of his legacy, saying that Rich's contributions to our monetary policy deliberations and his leadership, well, they will leave a lasting impact in the field of central banking. Mike, what legacy do you think Rich Clarida will leave?
Well, Clarida did a lot to help set up the new reaction function the Fed has of letting things run hot and letting the inflation rate rise above 2% to try to bring down the unemployment rate. He also did a lot of economic modeling for the Fed in terms of their responses to the crisis. But with Jay Powell going up to Capitol Hill tomorrow for his confirmation hearing for his reappointment as chairman, this may also be seen as an effort by Clarida to take some of the heat off of Powell. You can imagine that people like Elizabeth Warren might have made a big deal out of the fact that Clarida was still on the board. And Warren already today had said she was demanding that the Fed release information about Clarida's trading situation. So it may be that Clarida has sacrificed himself a little early to help Jay Powell out.
All right, we're talking with Bloomberg's Michael McKee. Again, the headline of this hour, Federal Reserve Vice Chair Rich Clarida intends to resign from the Board of Governors. That will happen on January 14th. This is 2 weeks before his term is due to expire. Hey, Mike, what does it mean for the discussions in and around the Federal Reserve, catching Jay Powell's ear about policy? How could this change the conversation, if you will, at the Fed?
It probably doesn't change the conversation a lot because everybody is, at this point, pretty much made their feelings known about what they should do. But the issue for the Fed is going to be they're going to be extremely shorthanded because we have already seen Randall Quarles leave. They were already down one Fed governor. And so at this point now they're off by 3. The president has been saying any day now he was going to appoint potential successors, but has not done so. This may ramp up the pressure on Joe Biden to act.
Hey, Mike, I want to go back to the confirmation hearing the Senate Banking Committee is holding tomorrow for Fed Chair Jerome Powell and his reappointment. You mentioned that this could take some heat off tomorrow. Do you still, though, expect some questions around allegations here? And do you expect some questions around that to Fed Chair Powell tomorrow?
No doubt we'll get that, especially from Elizabeth Warren, who's a member of the Banking Committee. She's been very critical of the Fed and its rules for trading and of Jay Powell for letting this happen, essentially. And so she's made it clear she's going to put some heat on him. She's already said she would oppose his nomination for chairman. As long as he gets some Republican support, he should be okay in being confirmed for a second term. But it isn't going to be an easy day for him tomorrow.
All right, Bloomberg's on Michael McKee there with the breaking news that Federal Reserve Vice Chair Richard Clarida intends to resign from the Board of Governors on January 14th, 2 weeks before his term was set to expire. Romaine Bostick here, Carol Masser, Tim Stenovic, Caroline Hyde, and Shanali Bassett. Keep an eye here on the market close, which just happened, and we do want to get back to that and walk you through some of the numbers because it was a pretty remarkable reversal here with most of the indices down 2 to 3% here on the day, but finishing the day relatively flat here. The S&P 500 only down 0.1% at 4670. The NASDAQ Composite and the NASDAQ 100 both managed to poke into the green at the close. The Dow Jones Industrial Average down about 0.4%, but it was down about 2% on the day. We did see a lot of that dip buying come back in, Caroline, particularly with Tesla, which was down like 5%, and then closed up a couple percentage points.
Yes, I'm sort of calling out that Adobe was also on the higher side. That sort of led the charge. As you said, when you're down more than 5% over the start of the year, maybe you are going to be attracted back. I thought the dip buying came in to a certain extent in U.S. Treasuries as well, which meant the yield came back off that 1.8% on the 10-year. But all of this is as we have a market anxious, not just about the Federal Reserve and how far off, how fast it will go for rate hikes. Remember what Goldman Sachs was talking about in its note. But we also had some worries about Omicron and the corporate perspective of that.
Yeah, absolutely. And that is something, I guess, as we start to get into earnings season, right? We've talked about Delta reporting and the big banks, what they have to say about the outlook in terms of the virus impact in particular, Tim.
Yeah, I'm also thinking about inflation later this week, that CPI number that we're set to get. We thought 6.8% year over year was high, but the question is, are people ready for a 7.1% read, which is what economists surveyed by Bloomberg are expecting.
Yeah, and when you look at the outlook at places like Lululemon, retailers really worried about that inflationary impact, especially as it comes to wages. At the end of the day, guys, what does all of this mean for not only what the Fed does, but what big tech valuations looks like under that scenario with the NASDAQ 100, NASDAQ Composite, both in the green, just slightly on the day?
You still have to kind of question the idea of risk appetite here. I mean, and yes, we did see a rebound here, but is this going to be sort of a broad-based dip buying where everybody comes back into that tech sector, or are they going to sort of cherry pick some of those names? Like we've seen this before where people gravitate to an Apple because of its quote-unquote defensiveness, or maybe the Tesla with sort of its moonshot capabilities. But what does this mean for some of those second-tier companies? What does it mean for a Bitcoin and some of those other riskier assets?
Where's Bitcoin at? 41,926 is where I see it.
It's still a could be worse, right?
So, but it did get under 40,000 today, so there was a dip that was bought at Bitcoin. So that may be perhaps being of an important technical level to some people.
Do you remember where you were when Bitcoin dipped below 40,000?
I was here working.
You know what's interesting? Strategic Research has Strategic Securities, has some research out, and they took a look. In the past 3 decades, there have been 4 distinct periods of rate hike cycles, and guess what was the best performing sectors during? Technology. Tech, yeah. So as we keep talking about pulling back from technology, if you look
but
at
this time it's
cycles,
different, Carol.
Is it?
I'm told.
Well, look at Amazon today. You know, Amazon today is a good example of this. I mean, Amazon hitting its lowest levels since May, despite the fact that Bank of America came out and actually put a positive read on it for the year. So Amazon's one of those companies that is pretty far off of its highs.
Well, we're going to listen to those earnings. We're going to see who's got the most visibility and whether or not as investors we feel confident, continuing to pour money into some of these high-flying names. All right, that's going to do it. A lot happening already on this first trading day of the week. We'll catch you again beyond the bell, our cross-platform coverage on radio, on TV, and on YouTube. We'll catch you same time, same place tomorrow.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
So, man, if anything, if there's already a theme here in 2022, it's like, folks, strap yourself in, put your seatbelts on, make sure you got lots of airbags around you because there's going to be a lot happening.
Well, what would happen? Well, I'm just thinking about somebody who, obviously we're in this all day, every day, Carol, and we're watching the markets like with one eye every single day at every single moment of the day. But what happens if, you tuned in at noon and then you tuned back in for the close? You're like, wait a second, the NASDAQ, closed in the green today?
Wait a minute.
Wait a second.
I love when you walked in before we got started, you said, I love it when the story, the markets, that's our story.
And even when...
And it is.
And it absolutely is today. It's so interesting because even those high-flying tech... I go back to ARK over and over again. New 52-week low today. Dip buyers came in. They bought the dip, it closed in the green.
So this is where you get back to, okay, what are your fundamentals as an investor? What's important to you? Do you buy the stories of a company that we understand the pandemic and the impact?
Amazon, for example.
But I mean, even when there's a shutdown, and so there might be another quarter where things aren't so great, do you believe the longer-term strategy? I mean, Kathy Wood, who would argue when it comes to her longer-term strategies that she stands by them. So this is as an investor, if you're in it for the long term, do you buy the fundamental story of something? Do you understand the balance sheet? Do you understand where the growth is? And so do you keep your money in them, or do you pull out and just kind of wait and let everything ride out?
That's the question. A couple other interesting observations I had looking at today's market. Volume was incredibly high. The S&P 500 higher by 20% over the last 20 days.
So the buyers who came in on the dip, you saw a lot of active volume.
Yeah, NASDAQ higher by more than 14%, so about 15% there. So they were very active.
You mentioned, and we talked about with our TV team, Caroline, Shanali, and Romaine, some of the economic news that's to come. And CPI, that print 7.1% year over year, that's what's expected for the month of December. It's backwards looking. Mm-hmm. And so do we, kind of shrug it off? Or do we start to think, well, wait a minute, if you're raising wages at certain places, that's sticky and that's going to stay with us. I mean, that's the things we have to figure out.
I'm more excited about this print than I was about the jobs report last week.
Really?
Yeah.
Why?
I don't know.
It's backwards looking. It's December.
So is the jobs report.
Yeah, I know.
Find me some of those forward-looking things in your crystal ball, okay?
And maybe we have to wait till February, right? More forward. I don't know. But this is what this week is going to be about. Lots. And it's interesting already to see that Monday trade. We'll see if it continues into the Tuesday trade. You're listening to Bloomberg Business Week. Carol Massar, Tim Stenovic on Bloomberg. All right, folks, you are listening to Bloomberg Business Week on this Monday. We did see stocks pretty much finish at their highs of the session. Quite a bounce back in the trade. Meantime, a couple of stories that really caught our attention involving PayPal and also Apple. There's a connection. If you did a org chart, it's like PayPal, Apple,
Where do you
Apple,
want to start?
PayPal.
Do you want to start with Apple or PayPal?
I kind of like the Apple story. Can
Okay,
we start there?
let's start with Apple. This one by Mark Gurman, whose voice you know well and whose writing you know well if you follow Bloomberg. Apple could shake up the fintech world with an Apple Card expansion, checking accounts, and more. This one is looking to expand its fintech ambitions to rival PayPal.
Yeah, over 1 billion people already use the iPhone to digitally manage key parts of their lives. That includes monitoring their health data, controlling their home, even starting their own their car, maybe their BMW.
I don't do that. I have a BMW though. So.
But I have used my car in an app to unlock it and to lock it.
Have you? You
Yeah.
can do that in your car?
Yep.
That's pretty cool.
Yep.
My car's too old.
Tim, time to come into the 21st century.
I know, I should.
The one area of daily life where Apple hasn't gotten as far as it should is financial management. The company has been working on things. In 2019, of course, it launched the Apple Card. There's been a lot of things. But it looks like maybe they're looking to do more.
Yeah, so it has a relationship with banks, namely Goldman Sachs. It has relationships with credit card and checking account data from customers, an image of trustworthiness and privacy, a history of taking complex tasks and making them simple. Apple has the building blocks to turn the iPhone and its ecosystem into the ultimate financial management tool. You should subscribe, if you don't already, to Power On. It's Mark Gurman's weekly newsletter. You can also email him and follow him on Twitter for this. But I get this each and every Sunday into my inbox. And it totally makes sense, Carol, because when you think about what Apple has been able to do with such a large number of people, if it can simplify finances, it can be even stickier. And you know, Apple's all about that ecosystem.
Exactly. I'm all in on Apple Pay at this point.
Yes,
the other story, also by Mark Gurman and Jenny Serene, has to do with PayPal exploring launch of its own stablecoin in a crypto push. But you can check that one out at Bloomberg.com. This is Bloomberg Radio.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Quite the recovery for the equity market today. We began on a rather sour note given the elevated long-term interest rates. At one point in the day, the S&P 500 was down 2%, but the benchmark only finished off a little less than 0.2%. We saw a recovery in many healthcare stocks that helped the market recover. Shares in Moderna today rallied by more than 9%. Dow Industrial Average weaker by 0.5% on the day, and where the NASDAQ Composite was concerned, an actual gain of about 0.1%. Hard hit though, we had shares of Nike falling about 4.5%. HSBC pointing out that Chinese demand is likely to remain lackluster. HSBC also noting some recent moves in the currency market that will adversely impact Nike, probably a stronger dollar. Lululemon Athletica shares down about 1.9% today. The company warned financial results will come in at the low end of its previous guidance. And we have a rally in shares of Zynga, the mobile game maker. Company's being acquired by Take-Two Interactive for a price of $11 billion. Shares in Take-Two today down 13%, but Zynga shares rallied more than 40%. 10-year Treasury last quoted in New York at a yield of 1.76%. I'm Doug Prisner. That is your Bloomberg Business Flash.
You're a big Farmville kind of guy, right, Doug?
I'm sorry, say that again?
Farmville? You're a big...
No, I have no idea what you're talking about. Could be speaking Latin to me.
Zynga's early hit, Farmville. Obviously, you're not a farmer.
Doug Prisner.
Yeah, neither am I, Doug.
We love you. We love you. Hey, just want to mention a headline crossing the Bloomberg terminal. Intel naming Micron's David Zizner as its new chief financial officer. So again, some executive...
What Ian King has to think about that.
I know. Intel's got its mission set out for it. Great story by Ian, by the way, right? We just talked about it with him earlier. Another great story on the Bloomberg has to be our Bloomberg Big Take. It's among the most read, in fact, on the Bloomberg. A story about the world's biggest crypto fortune, Tim, and how it began with a friendly poker game.
Yeah, and now CZ, as he's become known, the Binance CEO, is worth nearly $100 billion. Let's get into it with Tom Maloney, editor at Bloomberg News. He joins us on the phone from the New York City Bureau. Hey, Tom, congratulations on another fantastic story. This is just a great one that tells the life of CZ, as he's known, a Canadian citizen who was born in China, who's worth nearly $100 billion. Who are we talking about?
Yeah, so CZ, he basically spent his career developing trading systems. He studied computer science. He did a stint at Bloomberg, actually, and at some other firms. And then he heard about Bitcoin at a poker game from some friends, kind of went all in on cryptocurrency. And then in 2017, he founded Binance, which has become by far the largest cryptocurrency exchange in the world. And he's really made a huge fortune. As you said, he's worth nearly $100 billion now.
All right, so what's this friendly poker game we're talking about?
How do I get in? How do I get in on this?
So he was playing in Shanghai, actually. He spent some time developing trading systems in Asia and was playing with a couple of people who were early to cryptocurrency. They said you should put 10% of your net worth into crypto. He, read the white paper, did some research, and went in sort of full scale, sold his apartment in Shanghai for Bitcoin. So he was convinced.
Well, his wealth is inextricably bound to Binance. Explain what Binance is and why it's under scrutiny by regulators.
So, Binance is the world's biggest cryptocurrency exchange. So it's a place for people to trade various cryptocurrencies like Bitcoin, Ethereum, and so on. By volume, it's easily the biggest. It's a spot exchange is bigger than the next 4 exchanges combined. Derivatives, it's even more dominant, and it's under scrutiny from regulators, partly because it has become so big and so dominant, but also because, unlike some of the U.S. exchanges, it's been more of a traditional startup. It's more of a kind of a move fast and break things kind of an ethos. And I think that's gotten it quite a lot of scrutiny from regulators around the world.
Well, and it's interesting to see, his worth and what he's all about. Our own Eric Schatzker caught up with CZ and asked him about his wealth during a November interview in Singapore at the Bloomberg New Economy Forum event. And here's what CZ told Eric about all his wealth.
I don't really care about wealth, money, and also rankings, etc. I also I believe it was a Forbes interview just a couple of days ago. I said I will commit to donate 99% of my wealth away.
Okay, and again, that's him talking to Bloomberg's Eric Schatzker back in November. How do you say his name? I mean, I'll be honest with you, Tom. Tim and I are like, well, wait, we want to make sure we get this pronunciation. Everybody's calling him CZ. How do you say his full name?
Changpeng Zhao.
Okay.
But as you said, everybody calls him CZ, probably because he got sick of people mispronouncing it.
Smart. So how should we take this story? I'm thinking about, our Bloomberg listeners and our Bloomberg watchers on YouTube who are listening to what you have to say. I mean, he's an interesting individual, wealthy, super wealthy individual, but there's, as you said, a lot of regulatory agencies around the world looking into his company in a sector, industry, if you will, that we're all still trying to make sense of.
Well, I mean, I think this was a tricky one because this is a hugely profitable business, but there are still a lot of question marks over the future of crypto. I mean, just this week, it's had a sort of a terrible start to the year. And, this business as well it faces a lot of different regulatory probes, and we've seen other crypto exchanges that have really, we talked there about BitMEX, which was the biggest derivatives exchange in the world as well. Then the three founders got charged with crimes. They had to pay $100 million settlement. The founders are still awaiting trial. So, things can go downhill for these kind of businesses pretty quickly. At the same time, this is a firm that in 2021 we thought bought in $20 billion. So it's a real business making serious money. And we've seen crypto exchanges that are a fraction of the size, like Coinbase in the US, which is valued at about $50 billion. So, it's a tricky one, but it is a real business and it's got, real worth. And back in November, executives at the firm were said to be saying the firm could be worth $300 billion, which would make CZ even richer than $96 billion.
That's real money.
Yeah, a fraction of that is real money, too.
A fraction of it. All right, Tom, thank you so much. Really appreciate you joining us on this Monday. Tom Maloney, he's editor at Bloomberg News, on the phone from New York City with today's Bloomberg Big Take. You can catch that story, read it in its entirety at Bloomberg.com and, of course, on the Bloomberg Terminal. What?
That's a good poker tip.
I want to be part of that poker game.
I do, too.
Come on. Spread the wealth, everybody. You're listening to Bloomberg Radio and watching us on YouTube.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week, just crossing the Bloomberg terminal. Jay Powell, his prepared remarks for his testimony, his Senate confirmation hearing that's going to happen tomorrow morning, says the U.S. economy expanding at a fast pace and the labor market is strong.
Yeah, also saying the Fed will stop higher inflation from getting entrenched, and Powell will use the tools to support economy and strong job market. We're going to talk about all these headlines and more in just a few minutes with Kathleen Hayes.
All right, first up, let's get back to your top business stories and how the trading day ended up. Here is Doug Krisner.
Kind of a mixed day. Hey, Carol,
Yeah.
We finished off session lows. You know, it's kind of impressive to look at the recovery in the broader market. At one point, the S&P was down 2%. We ended down just a little more than 0.1%. It was really the recovery in healthcare leading the way higher. Moderna shares rallied today by more than 9%. The company has signed vaccine purchase agreements worth $18.5 billion for this year. And check this, Moderna also has options for another $3.5 billion worth in vaccines, and that would include booster shots. We're getting some news out of Intel. Late trading, the stock has popped on word that the company has named Micron's David Zinsner as Chief Financial Officer. Intel shares right now higher by more than 5%. But at the end of the day, the Dow was down 0.5%. NASDAQ comp looks like it's going to gain 0.1% on the day, and we mentioned the S&P weaker today by 0.2%. A lot of concern about the spike that we had today in interest rates. At one point, the 10-year Treasury had a yield of 180. That was after the former president of the New York Fed Bank, Bill Dudley, suggested the Fed is behind the curve. He told us the Fed needs to get more hawkish. And a short while ago, we learned on the subject of the Fed that Vice Chair Richard Clarida will resign from the Board of Governors on Friday. That's 2 weeks before his term is due to expire. I'm Doug Krisner, and that is your Bloomberg Business Flash.
It's only Monday, Krisner.
I'm tired.
You and me both. All right, Doug Krisner there with the Bloomberg Business News Flash. Doug mentioned the Federal Reserve Vice Chair Rich Clarida intending to resign from the Board of Governors on January 14th, as Doug mentioned, 2 weeks before his term is due to expire. We've got that headline, and then we've got Jay Powell, his prepared text before his Senate confirmation hearing that will happen tomorrow morning. Tim, you mentioned about Jay Powell saying that the Fed will stop higher inflation from getting entrenched. We've got that going on. He also said the economy expanding at a fast pace, labor market strong. Fed certainly front and center today.
Yeah, it certainly is. Let's get more on the Fed with Bloomberg News Global Economics and Policy Editor Kathleen Hayes, who joins us on the phone from our New York City bureau. Hey, Kathleen, a couple other headlines crossing the Bloomberg now. Fed policy must take a broad and forward-looking view, according to Fed Chair Powell's prepared testimony. The Fed will use tools to support the economy and strong job market. Any surprises in here to you from his testimony, at least what you're able to read so far?
Not at all. And I think that, you know, the Fed has painted a pretty clear picture of where they are, from saying for months inflation was transitory to the last meeting, not only saying, I guess we better drop that word. It does look like it's become more entrenched, more of a problem, but also that dramatic shift from only half of Fed officials, in fact, half of Fed officials not seeing the first rate increase until next year, 2023, to a full 100% move to everybody seeing at least one this year. In fact, 10 see 3 or more. So the Fed has laid down the gauntlet. They're going to start raising interest rates. So I think that is something that is clear from everything they've said and done so far, and it's going to be up to the Senate as they have this confirmation hearing tomorrow to dig out more.
Kathleen, I feel a little managed here. I feel like there's been some choreography that we had those headlines just after the market close. Fed Vice Chair Clarida leaving the board 2 weeks early, got that out there. We dealt with that. And then we had Jay Powell's prepared testimony, his remarks coming. I'm not saying that it is that we're being managed, but the timing is interesting, and we've just quickly shifted the conversation to economy off of Rich Clarida.
Well, maybe Rich Clarida intended his announcement that way. The Fed had made it pretty clear that they, in fact, they started doing this. You know, Carol, you and I remember, maybe Tim too, certainly. That remember they didn't used to release testimonies ahead of time, right? Well, I think even under late Janet Yellen, now under Jay Powell, he seems to be big fan of getting the basics of his testimonies out. That way they're in the market, right? Now, they did come after the close, but now everybody's kind of got it digested. The fact that Rich Clarida's retirement announcement came out. But remember, you guys, Rich Clarida's term is up in 2 weeks.
Right.
Yeah,
so why is he leaving early? I
think for a couple of reasons, probably. Number one, Lyle Brainerd has been nominated to replace him as vice chair. Her testimony is this week. I think he is just saying, look, I'm leaving. I have to leave by 2 weeks from now. Why not move now? These big testimonies are this week. I'm no longer going to be at the Fed. I'm not going to be at the January 26th meeting. To me, actually, it strikes me as a rather graceful move to just say, I'm stepping aside. Let's put the spotlight where it belongs.
But doesn't it also make it easier tomorrow on Fed Chair Powell in his questioning and in front of, when he's up on Capitol Hill?
In the sense of that I think I'm not sure what you're referring to. If you're referring to the fact that there's a kind of a second look at what his trades were in 2020 when the pandemic was raging, and subsequently this year, stories about Fed officials who were trading during a lot of the volatility in the markets, and Fed was taking some active steps. But again, let's remember, these were all reported to the Fed, and in fact, to the Board of Governors. Lael Brainerd, in fact, it was her job that was one of her many duties to watch over that. I don't know if anybody will ask her, why she didn't look at this sooner. I don't know. I just think the problem is that the Fed did things a certain way for so long, and in the pandemic it got a second look. I think that I'm not sure what the toughest part of Jay Powell's testimony would be. I think the easiest part will be the Republicans and Democrats agree we've got to get inflation down. The tougher questions might be if there's still, I think, more on the Democratic side, especially the progressive Democrats, who are a little bit worried about the Fed moving too fast and maybe hurting the economy. But unemployment's down 3.9%. It's a very tight labor market. Maybe anything won't be that hard. But when you sit down in front of Congress, you've got to be ready, right?
Hey, we assume, I think to a certain extent, Kathleen, that this confirmation process, it's just a matter of going through the steps. Is that truly the case?
Well, Carol, I think with Powell, that's probably true. He has a lot of support on both sides of the aisle. They're going to ask him tough questions. Again, they're not just going to raise rates. They're going to start reducing the balance sheet pretty soon, and that's kind of a new step. But I don't know if it'll be that level of going granular, as it would be if bond traders were interviewing him or questioning him tomorrow. But beyond that, I think the tougher one may be for Lael Brainerd. She is a card-carrying Democrat, which the Democrats, I'm sure, are very appreciative of. The Republicans might try to cast her as someone who's very politicized. I think that the climate change issue is something that maybe Lael Brainerd has been a more vocal proponent of the Fed looking at how it affects banks. There's this whole question of overreach by the Fed with some of these things on the Republican side. On the other hand, the Democrats are going to want her to talk about that. So I think that Jay Powell, Carol, I think you're right. I don't think this is going to be that tough. I think they're going to save a lot of toughness for Lael Brainerd on Thursday.
Okay, so give us a preview of what you expect to see from Brainerd on Thursday.
Well,
from lawmakers.
Well, first of all, let's ask a kind of I don't know what kind of question it is. Not a straw man kind of question. Gee, is the path of policy going to be affected by Lael Brainerd? Well, actually, she and Jay Powell, it seems, over the time that they've both been there, have worked very closely together. Ever since Powell got that seat, it seems to me, my sense is that Lael Brainerd has been an ally of Jay Powell's. I think they're on the same page when it comes to monetary policy. I really think that's the easy part. So it may be that's what she's going to emphasize, that where the policy is now, where they're heading, is something that she has helped shape. She's been there for several years now on the Board of Governors, and where she is ready to continue taking it.
We've got, 3 remaining vacancies on the Fed's board. We are expecting the White House to soon announce a slate of candidates to fill those seats. Do you think the Fed chief is going to get a bunch of questions about that, too?
That's a good question, Carol. And I assume what he's going to say is that's up to the White House. And no, I haven't been told what he's going to do. That's what I think his answer is probably going to be. But
does he care? How much does he care in terms of who else is going to be around that table or part of the discussion?
I think he probably cares a lot. And I think that when it comes, say, to Sarah Bloom Raskin, who has already been at the Board of Governors, she left to become the first female deputy secretary of the Treasury ever when Barack Obama asked her to do that.
Yep.
But I think, he wants people who are going to be smart on monetary policy, smart on what to do. It's the biggest challenge for the Fed now. It's the biggest challenge they faced in decades. I think that's what he's hoping for.
Always good to be smart, especially when you're talking about monetary policy. Kathleen Hayes, Bloomberg News Global Economics and Policy Editor, on the phone in our New York City bureau. This is Bloomberg Radio. All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovec. And
You ready for this? Are you ready for this?
I don't know. I don't know about anything grown in a lab and putting it into my mouth.
I was about to like go try to find something that was grown that is like regularly grown in labs. So the story we're talking about is from Bloomberg Business Week. It's by our own Ashley Vance.
Don't you think about all the horror movies that are out there? It's like grown in the lab.
Yeah, it's all fun and games until the lab-grown meat takes over.
It's funny until somebody gets hurt.
Right. Well, lab-grown meat, Ashley writes, is ready for its big FDA inspection. Near the end of last year, Upside Foods opened a meat processing plant like no other. It's a $50 million facility just outside Berkeley. Workers are cultivating small clumps of animal cells in large vats over 2 weeks. They're slowly growing them into chicken breasts and steaks, but no animal is slaughtered at any point in the process. The flesh is manufactured.
Cultivated meat, by the way, it's real meat, everybody. We're
not talking about plant-based stuff.
Exactly. It's the real Magilla.
I've never had it. Have you ever had it?
No.
We'd like tried it or
Where
something.
Where can we go?
I mean, if you were doing a reporting trip or something.
I guess you could try it, right?
Yeah, I'm sure.
All right, the techniques used to grow it are well developed. The problem for startups such as Upside is producing the meat in large quantities while achieving the smell, texture, and mouthfeel diners expect. We talk about feeding the world and the problems. We know the impact that farming in general, beef, cattle in particular, has on our environment. We're not going to go into the particulars. Just Google it if you want to know more.
Okay, guess what?
What?
Ashley got to eat it.
And?
Okay, so here's what he
did he
says.
say?
He said, when I tried an Upside chicken breast last year, it smelled and looked exactly like grilled chicken. It tasted like it too, though the texture was a bit softer and less juicy. His taste test required him to sign a waiver, and before the public gets the same chance to try it, Upside needs a green light from U.S. regulators. Both the FDA and Department of Agriculture have spent 3 years figuring out how they're going to monitor this industry.
Yeah, and it's interesting. They say, although cultivated meat itself is considered safe, there are plenty of unanswered questions about how often the vat should be cleaned and how the meat should be transported and stored. I
don't know.
Oh, my God. YouTube missed it, but Tim's face was pretty remarkable.
I don't know. I want to try it, but it's still...
I want
weird.
clean vats.
Yeah, me too.
This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market staged a bit of a recovery today. At the low point, the S&P was down 2%, but we had strength among healthcare stocks, leading the index to a loss of only about 0.1%, so significantly off the worst level of the day. As one example, within the healthcare space, Moderna shares rallied by more than 9%. The company has signed vaccine purchase agreements worth some $18.5 billion for this year, and on top of that, Moderna has options for another $3.5 billion worth of vaccines, including booster shots. Dow Industrial Average on the day down 0.5%. NASDAQ comp comes back from a loss to a gain of about 0.1%. Now, a lot of the early session weakness had to do with elevated long-term interest rates. We heard from the former president of the New York Fed Bank today, Bill Dudley. He told us the Fed is behind the curve when it comes to inflation, and he said the policy makers need to really get a lot more hawkish. So we had a 10-year Treasury at one point spiking to a yield of 1.80%. Now, in terms of the Fed, we'll hear from Fed Chair Jay Powell during his confirmation hearing tomorrow. Also tomorrow, a number of Fed speakers, including Kansas City Fed Bank President Esther George and St. Louis Fed Bank President Jim Bullard. A short while ago, we learned that Fed Vice Chair Richard Clarida intends to resign from the Board of Governors on Friday. That's 2 weeks before his term is set to expire. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Dougie, thank you so much. You're listening to Bloomberg Business Week. You know, over the summer, Bloomberg Intelligence put out a report saying the plant-based foods market alone could make up just under 8% of the global protein market by 2030, a value of over $162 billion, Tim. That's up from roughly $29 billion in 2020. And that's just food we're talking about.
And that's just plant-based. We're not talking lab-grown meat like we were just talking about.
I mean, there's a lot of stuff going on in terms of feeding the world. So let's get a perspective.
Noah Hyams is founder of Vegpreneur, joining us on the phone from Switzerland. Noah, how are you?
I'm doing well, Tim.
Good. Vegpreneur is the leading global community. It calls itself for founders and investors building sustainable, vegan, plant-based, ethical, animal-free, and cruelty-free companies. Give us an idea of how you're thinking about 2022 and beyond being the year for plant-based and moving away from animal products.
Yeah, absolutely. We've seen a tremendous amount of growth, specifically over the pandemic. And just to give you some perspective here, between 1980 and 2020, we had about $4.43 billion invested in plant-based food companies, and $2.15 billion were invested in 2020 alone. So you're seeing an accelerated amount of money, and I'm also seeing an accelerated amount of talent in our community that's growing, putting out more and more awesome plant-based products.
What kind of companies are they being invested in?
That's a great question. Good to be back, Carol. I hope you're well.
know. Yeah, you too.
We're looking at companies ranging from fashion to technology to food to farming. It's all over the place. Food obviously usually being front and center in the conversation. For example, Impossible Foods, which is the biggest rival to Beyond Meat, has raised just recently another $500 million, and it's now the most funded and fastest growing plant-based startup in the world.
You know, what's interesting, and Tim brought up a good point. We did just talk about Ashley Vance has a great story in Business Week, and it's about this lab-grown meat. In terms of plant-based, do you think food is going to be the big area going forward, or do you think there might be other areas of plant-based items that will definitely, that could possibly even surpass maybe our expectations for the food world?
Yeah, certainly. So plants are being used across the board. So if I understand your question correctly, there's a company right now that's raising money that is making hemp wool. So they're creating insulation that is non-toxic and captures CO2. There's a company that is using plants to basically reduce climate change. So they're forests as a service, if you will. They're also raising money. So you're seeing plants being used in a variety of ways. But yeah, food is obviously the one that most people think of first. There's a company in Germany which is using a very cool technology to create leather that is bio-based, meaning that it is plastic-free. And Melina Bucher is the brand, and she'll also be speaking at our summit at the end of the month.
Yeah, talk a little bit about that summit and how you're doing it. It's the Global Plant-Based Business Conference. It goes from January 29th to January 30th this year. Virtual?
Yes, we'll be virtual. We'll have awesome founders and investors joining us. For example, the former founder of Honest Tea, Seth Goldman, will be joining us.
Isn't he on the board of Beyond Meat?
He is. He is the executive chairman of the board of Beyond Meat, exactly. So hoping to get some insight on what's happening there. We've got the co-founder of Veggie Grill, which is the fastest growing and largest plant-based chain in the United States, and a lot of other awesome founders.
You know, what I think about, Noah, when we talk about something like this is it akin to some other, burgeoning industry 10 years ago or 20 years ago? I mean, how do you see it? What are you hearing from the conversations? Tim mentioned, Veggie, it's, founders, investors, leaders in the plant-based space. Are they likening it to some other growth market, I don't know, a few years ago, 10 years ago, 20 years ago?
Yeah, that's a really great question. I can't think of the specific market that it's similar to, but I will say that it's just blown up, as you can imagine. For example, we are in the month of January right now, and they're seeing record signups. I'm not sure if you're participating or not. But
we're participating here at work, actually. Our lunches every Monday are January-friendly lunches.
That's amazing.
Hey,
so we're seeing a third
go ahead, Noah.
Sorry. Yeah, we're seeing a third of the world population follow a diet based on reduction or elimination of meat. So you're just seeing extreme growth in like veganism, flexitarianism, vegetarianism. So it's hard for me to compare it to another industry, but it's definitely explosive.
Noah, I'm wondering how you're envisioning this playing out over the next few decades. Are you seeing us move in a way as humans, or at least in certain countries, almost completely away from animals and animal byproducts?
Well, if you're the founder of Impossible Foods, then yes. I very much hope the same thing, given the climate impact that animal agriculture has. Right now, there's a new report that just came out that said worldwide about 61% of consumers consider plants to be a preferred protein source, and most animals are farmed for food, so that is a very nice indicator. And I actually think in the Asia-Pacific region, we're going to see even more of that, given that what we consider alternative proteins in the West is definitely more normalized in their culture. So yes, I'm hoping by 2035 we are replacing some of the existing incumbent animal-based industries with plants.
Noah, when we think about plant-based, I mean, how do we support that? We're talking about massive greenhouses around the world, greenhouses on every building that's in the world. I mean, how do we think about it? Because I do wonder if there's enough land out there to support this plant-based economy going forward, especially if you look at the population growth that's out there.
Yeah, that's actually a great question. So as you can imagine, animals eat a lot more than we do. So we actually already grow enough plants to feed humans. So we would actually have to grow less plants if we moved completely to plant-based as opposed to feeding animals as well. In terms of greenhouses, yes, vertical farming is an exciting space. There are a lot of awesome companies, including Bowery Farming. We'll also have one of their leaders speaking at our summit to talk more about how they're envisioning bringing produce to more urban centers and allowing consumers to eat more fresh and healthy produce created indoors. But I think that one of the best ways to help is to invest your money into the plant-based space. And if you go to our website, vegepreneur.org/invest, you'll see all the incredible companies that are right now raising money. And I think it's always great in January specifically to align your values with your portfolio. So if you have money sitting around, maybe think about putting that in good use.
And go ahead, Carol.
No, go ahead.
I was just going to say very briefly in 10 seconds, what about consumers? What can consumers do?
Consumers can be a little bit curious. They can try new products. During the January right now, we're seeing great launches. For example, KFC just launched Beyond Fried Chicken, and I think there's never been a better time to be curious as a consumer.
All right, we got to run. Noah Hyams, he is founder of Vegpreneur, on the phone from Switzerland. That's going to do it for the Monday edition of Bloomberg Business Week. For Tim Stenovec, I'm Carol Massar. Have a safe evening, everyone.